prove that indexing wins. Well, the data are wrong. Over the short term, however, it doesn't always look as if the S&P 500 index, still the most common basis of comparison for mutual funds and pension plans, or the Dow Jones-Wilshire 5000 index is winning. That's because there is no possible way to calculate the returns earned by the millions of diverse participants, amateur and professional alike, Americans and investors in foreign countries, in the U.S. stock market. So what we do in the mutual fund field is calculate the returns of the various funds, counting each fund rather than each fund's assets as one entry. Since there are lots of small cap and mid cap funds, usually with relatively modest asset bases, they make a disproportionate impact on the data. When small and mid cap funds are leading the total market, the all market index fund seems to lag. When small and mid cap stocks are lagging the market, the index fund looks formidable indeed. Nonetheless, the exercise of calculating how the returns earned by the stock market itself compares with returns earned by the average equity fund is both illuminating and persuasive. If we compare the results of what are described as large-cap core funds with the returns of the S&P 500, because of its market capitalization weightings, a large-cap core index, the advantage of the index itself is impressive. During the 37-year period, 1969 to 2006, the S&P 500 index fell into the bottom quartile in only 2 years and has not done so since 1979. The index has outpaced the average fund in 26 of the remaining 35 years, including 11 of the past 15 years. Its average ranking was in the 58th percentile, that is, outperforming 58% of the comparable actively managed funds, leading, as we shall see in the next chapter, to enormous superiority over time. It is hard to imagine that even a single one of the large-cap core equity funds has a similar record of consistency. Consistency matters. A fund that is good or very good in the vast majority of years produces a far larger long-term return than a fund that is superb in half of the years and a disaster in the remaining half. Single-year rankings, then, ignore the sheer arithmetic advantage of that consistency. In the coming chapters, the impact of that long-term consistency is cataloged over the past 25 years. I should add that these annual data are what we call survivor biased. That is, that they exclude the records of the inevitably poorer performing funds that regularly go out of business. As a result, this further understates the success of the market-owning index strategy. Investing in the first index mutual fund, $15,000 invested in 1976, value in 2006, $461,771. Much criticism has been heaped on the S&P 500 for its choice of stocks, often picking new economy stocks such as JDS Uniphase and Yahoo near their inflated peak prices during the bubble just before they crashed, taking on a growth bias at exactly the wrong time. While the criticism is valid, the excellent long-term record of the flawed index belies the existence of a significant problem. In fact, since the market peaked early in 2000, the S&P 500 has had only a single significantly subpar year, 2000, 3 years at about par, and 3 years, 2003, 2004, and 2006, in the top quartile of its peers. I can't imagine that the vast majority of money managers wouldn't have been ecstatic with such an outcome. Thus, the recent era has not only failed to erode, but nicely enhanced the lifetime record of the world's first index fund, now known as Vanguard 500 Index Fund. Let me be specific. At a dinner on September 20, 2006, celebrating the 30th anniversary of the fund's initial public offering, the counsel for the fund's underwriters reported that he had purchased 1,000 shares at the original offering price of $15 per share, a $15,000 investment. The value of his holding that evening, including shares acquired through reinvesting the fund's dividends and distributions over the years, he proudly announced, was $461,771. Now there's a number that requires no comment. Well, maybe one comment. Of the 360 equity mutual funds then in existence, only 211 remain. This cumulative long-term winning record confirms that owning American business through a broadly diversified index fund is not only logical, but to say the least, incredibly productive. Equally important, it is consistent with the age-old principle expressed by Sir William of Ockham. Instead of joining the crowd of investors who try to gain an edge by dabbling in complex machinations involved in picking stocks and trying to outguess the stock market, two tasks that are inevitably fruitless for investors in the aggregate, choose the simplest of all solutions: buy and hold the market portfolio. Don't take my word for it. Before you write off the value of the simple index fund solution, recognize that it has been adopted as a cornerstone of investment strategy for many of the nation's pension plans operated by our giant corporations and state and local governments. Indexing is also the predominant strategy for the largest of them all, the retirement plan for federal government employees, the Federal Thrift Savings Plan. The plan has been a remarkable success and now holds some $173 billion of assets for the benefit of our public servants and members of uniformed services. Under the plan, the various government departments automatically make a contribution equal to 1% of annual pay, and matching contributions of up to 5% of pay, meaning that a federal employee who contributes 5% of their salary to the plan receives a total matching contribution of 6%. All contributions and earnings are tax-deferred until withdrawal, much like the corporate 401k thrift plans. Overcoming what must have been some serious reservations, even the Bush administration determined to follow the Federal Thrift Savings Plan model in its plan for personal savings accounts as an optional alternative to our Social Security program. Indexing is also praised across the Atlantic pond. Listen to these words from Jonathan Davis, columnist for the London Spectator. Nothing highlights better the continuing gap between rhetoric and substance in British financial services than the failure of providers here to emulate Jack Bogle's index fund success in the United States. Every professional in the city knows that index funds should be core building blocks in any long-term investor's portfolio. Since 1976, the Vanguard Index Fund has produced a compound annual return of 12%, better than 3/4 of its peer group. Yet even 30 years on, ignorance and professional omerta still stand in the way of more investors enjoying the fruits of this unsung hero of the investment world. Chapter 4. Why Most Investors Lose to the Market. The Relentless Rules of Humble Arithmetic. Before we turn to the success of indexing as an investment strategy, let's explore in a bit more depth just why it is that investors as a group fail to earn the returns our corporations generate through their dividends and earnings growth, ultimately reflected in the long run in the prices of their stocks. To understand why they do not, we need only to recognize the simple mathematics of investing. All investors as a group must necessarily earn precisely the market return, but only before the costs of investing are deducted. After subtracting the costs of financial intermediation, all of those management fees, all of those brokerage commissions, all of those sales loads, all of those advertising costs, all of those operating costs, the returns of investors as a group must and will and do fall short of the market return by an amount precisely equal to the aggregate amount of those costs. In a market that returns 10%, we investors together earn a gross return of 10%. Duh. But after we pay our financial intermediaries, we pocket only what remains. And we pay them whether our returns are positive or negative. In investing, as a group we get precisely what we don't pay for. So if we pay nothing, we get everything. There are, then, these two certainties. 1. Beating the market before costs is a zero-sum game. 2. Beating the market after costs is a loser's game. The returns earned by investors in the aggregate inevitably fall well short of the returns that are realized in our financial markets. How much do these costs come to? For individual investors holding stocks directly, Trading costs average about 1.5% per year. That cost is lower, about 1% for those who trade infrequently, and much higher for investors who trade frequently. For example, 3% for investors who turn their portfolios over at a rate above 200% per year. In equity mutual funds, management fees and operating expenses, combined, the expense ratio, average about 1.5% per year of fund assets. Then add, say, another 0.5% in sales charges, assuming that a 5% initial sales charge is spread over a 10-year holding period. If the shares are held for 5 years, the cost would be twice that figure, 1% per year. But then add a giant additional cost, all the more pernicious by being invisible. I'm referring to the hidden cost of portfolio turnover, estimated at a full 1% per year. The average fund turns its portfolio over at a rate of about 100% per year, meaning that a $5 billion fund buys $5 billion of stocks each year and sells another $5 billion. At that rate, brokerage commissions, bid-ask spreads, and market impact costs add a major layer of additional costs. Result: the all-in cost of equity fund ownership can come to as much as 3% to 3.5% per year. I've ignored the hidden opportunity cost that fund investors pay. Most equity funds hold about 5% in cash reserves. If stocks earn a 10% return and these reserves earn 4%, that cost would add another 0.3% to the annual cost, 5% times the 6% differential in earnings. So yes, costs matter. The grim irony of investing, then, is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. So if we pay nothing, we get everything. Let me illustrate this simple lesson with a wonderful quotation I came across a few years ago when I was rereading Other People's Money by Louis D. Brandeis, first published in 1914. Brandeis, later to become one of the most influential jurists in the history of the U.S. Supreme Court, railed against the oligarchs who a century ago controlled investment America and corporate America alike. Brandeis described their self-serving financial management and their interlocking interests as trampling with impunity on laws human and divine, obsessed with the delusion that 2 + 2 make 5. He predicted, accurately as it turned out, that the widespread speculation of that era would collapse, a victim of the relentless rules of humble arithmetic. He then added this unattributed warning. I'm guessing it's from Sophocles. Remember, O stranger, arithmetic is the first of the sciences and the mother of safety. Brandeis's words hit me like the proverbial ton of bricks. Why? Because the relentless rules of the arithmetic of investing are themselves so obvious. It's been said, by my detractors, that all I have going for me is the uncanny ability to recognize the obvious. The curious fact is that most investors either seem to have difficulty recognizing what lies in plain sight, right before their eyes, or, perhaps even more pervasively, refuse to recognize the reality because it flies in the face of their deep-seated beliefs and their biases, their overconfidence, and their uncritical acceptance of the way that financial markets have worked, seemingly forever. What is more, it is hardly in the interest of our financial intermediaries to encourage their investor clients to recognize the obvious reality. Indeed, the self-interest of the leaders of our financial system almost compels them to ignore these relentless rules. Paraphrasing Upton Sinclair, it's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it. Our system of financial intermediation has created enormous fortunes for those in the field of managing other people's money. Their self-interest will not soon change. But as an investor, you must look after your own self-interest, for only by facing the obvious realities of investing can the intelligent investor succeed. How much do the costs of financial intermediation matter? A ton. Indeed, the higher costs of equity funds have played the determinative role in explaining why fund managers have lagged the returns of the stock market itself so consistently for so long. When you think about it, how could it be otherwise? By and large, these managers are smart, well-educated, experienced, knowledgeable, and honest. But they are competing with each other. When one buys a stock, another sells it. There is no net gain to fund shareholders as a group. In fact, they incur a loss equal to the transaction costs they pay to those helpers that Mr. Buffett warned us about in Chapter 1. Investors pay far too little attention to the costs of investing. It's especially easy to underrate their importance under today's conditions. 1. When many costs are hidden from view, portfolio transaction costs, the unrecognized impact of front-end sales changes, taxes incurred on realized gains. 2. When stock market returns have been high. During the 1980s and 1990s, stock returns averaged 17.5% per year, and the average fund provided a non-trivial but clearly inadequate return of 15%. And especially 3. When investors focus on short-term returns, ignoring the truly confiscatory impact of cost over an investment lifetime. Perhaps an example will help. Let's assume the stock market generates a total return averaging 8% per year over a half-century. Yes, that's a long time, but an investment lifetime is now actually even longer. 65 or 70 years for an investor who goes to work at age 22 and begins to invest immediately and works until, say, age 65, and then continues to invest for an actuarial expectancy of 20 or more years thereafter. Now let's assume that the costs of the average mutual fund continue at their present rate of at least 2.5% per year. Result? A net annual return of just 5.5% for the average fund. $10,000 grows to $469,000, or $145,400. Where did that $323,600 go? Based on these assumptions, let's look at the returns earned on $10,000 over 50 years. The simple investment in the stock market grows to $469,000, a remarkable illustration of the magic of compounding returns over an investment lifetime. In the early years, growth at a 5.5% annual rate doesn't look all that different from the growth in the stock market itself. But ever so slowly, the rates begin to diverge, finally, truly dramatically. By the end of the long period, the value accumulated in the fund totals just $145,400, an astonishing shortfall of $323,600 to the cumulative return earned in the market itself. In the investment field, time doesn't heal all wounds. It makes them worse. Where returns are concerned, time is your friend. But where costs are concerned, time is your enemy. This point is powerfully illustrated when we consider how much of the value of the $10,000 investment is eroded with each passing year. By the end of the first year, only about 2% of the value of your capital has vanished, $10,800 versus $10,550. By the 10th year, 21% has vanished, $21,600 versus $17,100. By the 30th year, 50% has vanished, $100,600 versus $49,800. And by the end of the period, costs have consumed nearly 70% of the potential accumulation available simply by holding the market portfolio. The investor, who put up 100% of the capital and assumed 100% of the risk, earned but 31% of the market return. The system of financial intermediation, which put up 0% of the capital and assumed 0% of the risk, essentially confiscated 70% of that return, surely the lion's share. What we see here, and please don't ever forget it, is that over the long term, the miracle of compounding returns is overwhelmed by the tyranny of compounding costs. Add that mathematical certainty to the relentless rules of humble arithmetic described earlier. But enough of theory and hypothetical examples. Let's see how this principle works in the real world. During the quarter century from 1980 to 2005, the return on the stock market itself, measured by the Standard & Poor's 500 index, averaged 12.5% per year. The return on the average mutual fund averaged just 10%. That 2.5% differential is about what one might have expected, given our earlier 3% rough estimate of fund costs. Never forget, market return minus cost equals investor return. Simply put, our fund managers, sitting at the top of the investment food chain, have confiscated an excessive share of the financial market's returns. Fund investors, inevitably at the bottom of the food chain, have been left with too small a share. Investors need not have incurred that loss, for they could have easily invested in a simple index fund tracking the S&P 500 index. Such a fund actually returned 12.3% per year during that period, the market return of 12.5%, less costs of just 0.2%. That's an annual margin of superiority of 2.3% over the average fund. On first impression, that annual gap may not look large, but when compounded over 25 years, it reaches staggering proportions. A $10,000 initial investment in the index fund grew by a remarkable $170,800 compared to growth of just $98,200 in the average equity mutual fund, only 57% of the total accumulation in the index fund. But let's face the facts. Both of these accumulations are overstated, for they are based on current 2005 dollars, which have less than half the spending power they enjoyed in 1980. During this period, inflation eroded the real buying power of these returns at an average rate of 3.3% per year. When we turn those nominal dollars, the dollars that we earn and spend and invest every day, into real dollars, dollars that are adjusted to take inflation into account, the results for that original $10,000 investment tumble sharply. The cumulative real profit after compounding came to just $40,600 for the average actively managed equity fund, compared to $76,200 for the passively managed index fund. Now, the average fund produced barely one-half, actually 53%, of the profit earned by the stock market itself through the simple index fund, a return that was there for the taking. It's in the nature of arithmetic that deducting the same inflation rate from both figures further increases the comparative advantage of the investment with the higher return, in this case, the index fund. Yes, costs matter. Indeed, costs make the difference between investment success and investment failure. In short, the humble arithmetic of investing, the logical, inevitable, and unyielding penalty assessed by investment costs and rising living costs, has devastated the returns earned by mutual fund investors. Using Justice Brandeis's formulation, our mutual fund managers seem obsessed with the delusion, and are foisting that delusion on investors, that a nominal gross return of 12.5% per year in the stock market, minus fund expenses of 2.5%, minus inflation of 3.3%, still equals a real net return of 12.5%. Well, to state the obvious, it doesn't. You can add and subtract for yourself. It equals, you guessed it, only 6.7%. Unless the fund industry changes and improves the net return it delivers to fund shareholders, it will falter and finally fail, a victim, yes, of the relentless rules of humble arithmetic. Were he looking over your shoulder as you read this book, Justice Brandeis surely would be warning you, remember, O reader, that arithmetic is the first of the sciences and the mother of safety. So sharpen your pencils. Do your own arithmetic. Realize that you are not consigned to playing the hyperactive management game that is played by the overwhelming majority of individual investors and mutual fund owners alike. The index fund is there to guarantee that you will earn your fair share of whatever returns our businesses earn and our stock market delivers. Don't take my word for it. The innate superiority of the index fund has, perhaps grudgingly, been endorsed by at least a few mutual fund industry insiders. When he retired, here's Peter Lynch, the legendary manager who steered Fidelity Magellan Fund to such great success during his 1977 to 1990 tenure. The S&P is up 343.8% for 10 years. That is a four-bagger. The general equity funds are up 283%. So it's getting worse. The deterioration by professionals is getting worse. The public would be better off in an index fund. Now hear industry leader John Fossil, former chairman of the Investment Company Institute and of the Oppenheimer funds. People ought to recognize that the average fund can never outperform the market in total. Even hyperactive investors seem to believe in indexing strategies. Here's what James J. Cramer, money manager and host of CNBC's Mad Money, says. After a lifetime of picking stocks, I have to admit that Bogle's arguments in favor of the index fund have me thinking of joining him rather than trying to beat him. Bogle's wisdom and common sense are indispensable for anyone trying to figure out how to invest in this crazy stock market. And hedge fund managers too join the chorus. One of the industry's giants, Clifford A. Asness, manager and founding principal of AQR Capital Management, adds his own wisdom, expertise, and integrity. Market cap-based indexing will never be driven from its deserved perch as core and deserved king of the investment world. It is what we should all own in theory, and it has delivered low-cost equity returns to a great mass of investors. The now and forever king of the hill. Chapter 5. The Grand Illusion. Surprise! The returns reported by mutual funds aren't actually earned by mutual fund investors. It's gratifying that industry insiders such as the ICI's Mr. Fossil, Fidelity's Mr. Lynch, Mad Money's Mr. Cramer, and AQR's Mr. Asness agree with me about the inevitable inadequacy of returns earned by the equity mutual fund relative to the returns available simply by owning the stock market itself through an index fund based on the S&P 500. But the idea that fund investors actually earn those returns proves to be a grand illusion. Not only an illusion, but a generous one. The reality is, in fact, considerably worse. For in addition to those heavy costs that fund managers extract from their shareholders, the shareholders themselves pay a second, additional cost that has been even larger. During the 25-year period that we examined in the previous chapter, the returns we showed were based on the traditional time-weighted returns reported by the funds themselves, the change in the asset value of each fund share, adjusted to reflect the reinvestment of all income dividends and capital gains distributions. But that return does not tell us what return was earned by the average fund investor, and it turns out to be far lower. To ascertain the return earned by the average fund investor, we must consider not only the time-weighted return, but also consider the dollar-weighted return, which accounts for the impact of capital flows from investors into and out of the fund. For example, if a $100 million fund earns a return of 30% during a given year, and $1 billion of its shares are purchased during the final day of the year, the average return earned by its investors would be just 5.4%. Hint: money comes into most funds after good performance is achieved and goes out when bad performance follows. When we compare traditionally calculated fund returns with the returns actually earned by their investors over the past quarter century, it turns out that the average fund investor earned not the 10% earned by the average fund, but 7.3%, an annual return fully 2.7 percentage points per year less than that of the average fund. In fairness, the index fund investor, too, was enticed by the rising market and earned a return of 10.8%, 1.5 percentage points short of the fund return itself. Yes, during the past 25 years, while the stock market index fund was providing an annual return of 12.3%, and the average equity fund was earning an annual return of 10%, The average fund investor was earning only 7.3% a year. Compounded over the full period, as we saw in the previous chapter, the 2.5% penalty incurred by the average fund because of costs was huge. But the dual penalties of faulty timing and adverse selection were even larger. From 1980 to 2005, $10,000 invested in the index fund grew to $170,800. In the average equity fund, to $98,200, just 57% of what was there for the taking. But the compound return earned by the average fund investor tumbled to $48,200, a stunning 28% of the return on the simple index fund. And once again, the values of all those dollars tumble when, as we must, we take inflation into account. The index fund real return drops to 9% per year, but the real return of the average fund investor plummets to just 4%. On a compounded basis, $76,200 of real value for the index fund versus just $16,700 for the fund investor. Only 22% of the potential accumulation that was there for the taking. Truth told, it's hard to imagine such a staggering gap, but facts are facts. Please be clear that while the data clearly indicate that fund investor returns fell well short of fund returns, there is no way to be precise about the exact shortfall. We estimated the gap based on the difference between the 10-year time-weighted returns on the 200 largest mutual funds in 1999 and their actual dollar-weighted returns during the same period. But the point of this statistical examination of the returns earned by the stock market, the average fund, and the average fund owner is not precision, but direction. Whatever the precise data, the evidence is compelling that equity fund returns lag the stock market by a substantial amount, largely accounted for by their costs, and that fund investor returns lag fund returns by an even larger amount. What explains this shocking lag? Simply put, counterproductive market timing and fund selection. First, shareholders investing in equity funds paid a heavy timing penalty. They invested too little of their savings in equity funds during the 1980s and early 1990s, when stocks represented good values. Then, inflamed by the heady optimism and greed of the era, and enticed by the wiles of mutual fund marketers as the bull market neared its peak, they poured too much of their savings into equity funds. Second, they paid a selection penalty, pouring their money into the market not only at the wrong time, but into the wrong funds. This lag effect was amazingly pervasive. In the past decade, for example, the returns actually provided to investors by 198 of the 200 most popular equity funds were actually lower than the returns that they reported to investors. This lag was especially evident during the new economy craze of the late 1990s. Then, the fund industry organized more and more funds, usually funds that carried considerably higher risk than the stock market itself, and magnified the problem by heavily advertising the eye-catching past returns earned by its hottest funds. As the market soared, investors poured even larger sums of money into equity funds. They invested a net total of only $18 billion in 1990 when stocks were cheap, but $420 billion in 1999 and 2000 when stocks were overvalued. What's more, they also chose overwhelmingly the highest risk growth funds, to the virtual exclusion of more conservative, value-oriented funds. While only 20% of their money went into risky aggressive growth funds in 1990, fully 95% went into such funds during their peak years of 1999 to 2000. After the fall, when it was too late, their purchases dried up to as little as $50 billion in 2002, when the market hit bottom. They also pulled their money out of growth funds and turned, too late, to value funds. The problem can be illustrated by observing the experience of the most popular growth funds of 5 giant fund families with the largest cash inflows, altogether more than $150 billion in 1996 to 2000 inclusive. During those 5 years, These aggressive funds provided spectacular records, annual returns averaging 21% per year, well above even the outstanding return of 18.4% on the S&P 500 index fund. But during the 5 years that followed, in 2001 to 2005, retribution followed. While the index fund eked out a small gain, less than 1% per year, the returns of these aggressive, risk-laden funds tumbled into negative territory. For the full 10 years, taking into account both their rise and their fall, the returns reported by these aggressive funds were actually quite acceptable, an average of 7.8% per year, nearly equal to the return of 9.1% for the index fund. But woe to the shareholder who chose them. For while the fund returns were acceptable, the returns of their shareholders were, well, terrible. Their average return came to minus 0.4% per year, in negative territory, and a lag of fully 8.3 percentage points behind the fund's reported per-share figure. For the record, the annual return of the index fund shareholder, at 7.1%, also lagged the return of the fund itself, but by only 2 percentage points, far less than this group's gap of 8.3 percentage points, or even the industry gap of 2.7 percentage points. When the annual returns of these aggressive funds are compounded over the full period, the deterioration is stunning. A cumulative fund return averaging more than 112%, a cumulative shareholder return averaging negative 4.5%. That's a lag of more than 117 percentage points. This astonishing penalty, then, makes clear the perils of fund selection and timing. It also illustrates the value of indexing and the necessity of setting a sound course and then sticking to it, come what may. The shocking performance of fund investors during the stock market new economy bubble is unusual in its dimension, but not in its existence. Fund investors have been chasing past performance since time eternal, allowing their emotions, perhaps even their greed, to overwhelm their reason. But the fund industry itself has played on these emotions, bringing out new funds to meet the fads and fashions of the day, often supercharged and speculative, and then aggressively advertising and marketing them. It is fair to say that whenever counterproductive investor emotions are played on by ever counterproductive fund industry promotions, little good is apt to result. The fund industry will not soon give up its promotions, but the intelligent investor will be well advised to heed not only the message in Chapter 4 about minimizing expenses, but the message in this chapter about getting emotions out of the equation. The beauty of the index fund, then, lies not only in its low expenses, but in the fact that it eliminates all those tempting fund choices that promise so much and deliver so little. The index fund, on the other hand, can be held through thick and thin for an investment lifetime, and emotions need never enter the equation. The winning formula for success in investing is owning the entire stock market through an index fund, and then doing nothing. Just stay the course. Don't take my word for it. The wise Warren Buffett shares my view in what I call his 4 E's. The greatest enemies of the equity investor are expenses and emotions. Even Andrew Lo, MIT professor and author of A Non-Random Walk Down Wall Street, suggesting strategies to outperform the market, personally invests by buying and holding index funds. Perhaps even more surprisingly, even the founder and chief executive of the largest mutual supermarket, vigorously promoting actively managed funds, favors the classic index fund. When asked why people invest in managed funds, Charles Schwab answered, "It's fun to play around. It's human nature to try to select the right horse. But for the average person, I'm more of an indexer. The predictability is so high. For 10, 15, 20 years, you'll be in the 85th percentile of performance. Why would you screw it up?" Mark Holbert, highly regarded editor of the Holbert Financial Digest, concurs. Assuming that the future is like the past, You can outperform 80% of your fellow investors over the next several decades by investing in an index fund and doing nothing else. But acquire the discipline to do something even better. Become a long-term index fund investor. His New York Times article was headlined, "Buy and Hold? Sure, but don't forget the hold." Chapter 6. Taxes are costs too. Don't forget Uncle Sam. We aren't yet quite through with the relentless rules of humble arithmetic. The logical, inevitable, and unyielding long-term penalties assessed against stock market participants by investment expenses, and the powerful impact of inflation. Together, they have slashed the capital accumulated by mutual fund investors. The index fund has provided excellent protection from the penalty of costs, as we have just seen in Chapter 4. While its real returns too were hurt by inflation, the cumulative impact was far less than on the actively managed equity funds. But there is yet another cost, too often ignored, that slashes the net returns that investors actually receive even further. I'm referring to taxes, federal, state, and local income taxes. Note, about 1/2 of all equity mutual fund shares are held by individual investors in fully taxable investment accounts. The other half are held in tax-deferred accounts, such as individual retirement accounts, IRAs, and corporate savings, thrift, and profit-sharing plans. If your fund holdings are solely in the latter category, you need not be concerned with the discussion in this chapter. And here again, the index fund garners a substantial edge. The fact is that managed mutual funds are astonishingly tax inefficient, a result of the short-term focus of their portfolio managers, usually frenetic traders of the stocks in the portfolios they supervise. The turnover of the average equity fund now comes to about 100% per year. In fairness, based on total assets rather than number of funds, the turnover rate of actively managed funds is 61%. Industry-wide, the average stock is held by the average fund for an average of just 12 months, 20 months based on equity fund total assets. Hard as it is to imagine, during 1945 to 1965, the turnover rate averaged just 16% per year, an average holding period of 6 years for the average stock in a fund portfolio. As we have already seen, the huge increase in turnover and in its attendant transaction costs have ill-served fund investors. This pattern of tax inefficiency for active managers seems destined to continue so long as A. Stocks rise, and B. Fund managers continue their hyperactive patterns of short-term trading. Let's be clear. Once focused on long-term investment, fund managers are now focused on short-term speculation. But the index fund is precisely the opposite, buying and holding forever, and incurring transaction costs that are somewhere between zero and infinitesimal. So let's pick up where we left off 2 chapters ago, with the net annual return of 10% for the average equity fund over the past 25 years, compared with the 12.3% return for the S&P 500 index fund. With the high portfolio turnover of actively managed funds, their taxable investors were subject to an estimated effective annual federal tax of 1.8 percentage points per year. State and local taxes would further balloon the figure, reducing the after-tax annual return to 8.2%. Despite the higher returns that they earned, investors in the index fund were actually subjected to lower taxes. In fact, at 0.6 percentage points, only about 1/3 of that tax burden, bringing their after-tax return to 11.7%. Compounded, the initial $10,000 investment grew by just $61,700 after taxes for the active funds, nearly 60% less than the $149,000 of accumulated growth in the index fund. Yes, the index fund investor would be subject to taxes on any gains realized when he liquidates his shares. But for an investor who bequeaths shares to his heirs, the cost would be stepped up, and no gain would be recognized nor taxed. What's more, just as fund expenses are paid in current dollars, so is your annual tax bill. When we calculate the accumulated wealth in terms of real dollars with 1980 buying power, investor wealth again contracts dramatically. The annual real return of the average equity fund now drops to 4.9%, less than half of the 8.4% actual return of the index fund. Compounded, the real after-tax accumulation on that initial $10,000 came to $65,100 for the index fund, nearly 3 times the $23,100 for the active equity index fund. Even with the more subdued returns earned in the post-bubble era, actively managed funds persist in foisting this extraordinarily costly tax inefficiency on their shareholders. While the net annual return of the average equity fund was 8.5% over the past decade, 1996 to 2005, the tax bill consumed fully 1.7 percentage points of the return, reducing the net fund return to just 6.8%. I hesitate to assign the responsibility for being the straw that broke the camel's back of equity fund returns to any single one of these negative factors. But surely the final straws include 1. High costs, 2. The adverse investor selections and counterproductive market timing described in the previous chapter, and 3. Taxes. Perhaps it doesn't matter. The camel's back is surely broken, but the last straw, it turns out, is inflation. When we pay our fund costs in current dollars year after year, and that's exactly how we pay our fund expenses and our taxes on fund capital gains, often realized on a short-term basis to boot, and yet accumulate our assets only in real dollars, eroded by the relentless rise in the cost of living that seems embedded in our economy, the results are devastating. It is truly remarkable, and hardly praiseworthy, that this devastation is virtually ignored in the information that fund managers provide to fund investors. A paradox. While the index fund is remarkably tax efficient in terms of managing capital gains, it turns out to be relatively tax inefficient in terms of distributing dividend income. Why? Because its rock-bottom costs mean that nearly all of the dividends paid on the stocks held by the index fund actually flow directly into the hands of the index fund shareholders. On the other hand, with the high expense ratios incurred by managed funds, only a tiny portion of the dividends the funds receive actually find their way into the hands of the fund's shareholders. Here is the unsurprising and ever-relentless arithmetic. The annual gross dividend yield earned by the typical active equity fund, before deducting fund expenses, is about the same as the dividend yield of the low-cost index fund, 1.8% in mid-2006. But since the typical active fund bears an expense ratio of 1.5%, it confiscates fully 80% of its dividend income, a reaffirmation of the eternal position of fund investors at the bottom of the mutual fund food chain. The result? A net dividend yield of just 0.3% for its owners. On the other hand, the expense ratio of a low-cost index fund is about 0.15%, consuming only 8% of its 1.8% dividend yield. The result? A net yield of 1.65% to distribute to the passively managed index fund owners, a dividend nearly 5.5 times as high as the dividend on the actively managed fund. Yes, for taxable shareholders, that larger dividend is subject to the current 15% tax on dividend income, consuming about 0.27 percentage points of the yield. Paradoxically, the active fund, with an effective tax rate of just 0.045%, 15% of the 0.3% net yield, appears more tax efficient from a dividend standpoint. But the reality is that the tax imposed by the active managers in the form of the fees it deducts before paying those dividends has already consumed 80% of the yield. Surely the wise investor will seek the dividend tax inefficiency of the index fund rather than the tax efficiency engendered by the confiscatory operating costs of most actively managed funds. Don't take my word for it. Consider these words from a paper by John B. Chauvin of Stanford University and the National Bureau of Economic Research, and Joel M. Dixon, then of the Federal Reserve System. Mutual funds have failed to manage their realized capital gains in such a way as to permit a substantial deferral of taxes, raising investors' tax bills considerably. If the Vanguard 500 index fund could have deferred all of its realized capital gains, it would have ended up in the 91.8 percentile for the high-tax investor. That is, outpaced 92% of other equity funds. Or listen again to investment advisor William Bernstein, author of The Four Pillars of Investing. While it is probably a poor idea to own actively managed mutual funds in general, it is truly a terrible idea to own them in taxable accounts. Taxes are a drag on performance of 4 percentage points each year. Many index funds allow your capital gains to grow largely undisturbed until you sell. For the taxable investor, indexing means never having to say you're sorry. And Dr. Malkiel again casts his lot with the index fund. Index funds are tax-friendly, allowing investors to defer the realization of capital gains or avoid them completely if the shares are later bequeathed. To the extent that the long-run uptrend in stock prices continues, switching from security to security involves realizing capital gains that are subject to tax. Taxes are a crucially important financial consideration because the earlier realization of capital gains will substantially reduce net returns. Index funds do not trade from security to security, and thus they tend to avoid capital gains taxes. Chapter 7. Returns during the past 25 years were far above long-term norms. What happens if future returns are lower? Let me begin by reminding you of the unfailing principle that I described in Chapter 2. In the long run, it is the reality of business, the dividend yields and earnings growth of America's corporations, that drives the returns generated by our stock markets. As a result, I must warn you that the 12.5% nominal annual return provided by the U.S. stock market during the past 25 years, the period that I have examined in the 3 preceding chapters, was far above the century-long historical norm of about 9.5%. Recall that the century-plus nominal investment return earned by stocks was 9.5%, consisting of an average dividend yield of 4.5% and average annual earnings growth of 5%. A mere 0.1% per year, what I described as speculative return, was added by the rise in the price-earnings ratio from 15 times at the beginning of the period to 18 times at its end, bringing the total annual return to 9.6%. Paradoxically, the investment return earned by stocks over the past 25 years was hardly extraordinary. A dividend yield averaging 3.4% plus annual earnings growth of 6.4% brought it to 9.8%, almost precisely equal to the historical norm of 9.5%. But illustrating the difficulty of forecasting changes in the amount that investors are willing to pay for each dollar of corporate earnings, the speculative return was anything but normal. As investor confidence rose, so did the price-earnings ratio rise, from 9 times to 18 times, an amazing 100% increase. Adding fully 2.7 percentage points per year, fully 30%, to the solid 9.8% fundamental return. Early in 2000, the price-earnings ratio had actually risen to an astonishing 32 times, only to plummet to 18 times as the new economy bubble burst. Result: speculative return was responsible for more than 20% of the market's 12.5% annual return during this period. Since we can't realistically expect the P/E ratio to double in the years immediately ahead, we can't expect a similar 12.5% return to recur. It seems clear that we're facing an era of subdued returns in the stock market. Why? First, because today's dividend yield on stocks is not 4.5%, the historical rate, but slightly below 2%. Thus, we can expect a deadweight loss of 2.5 percentage points per year in the contribution of dividend income to investment return. Then let's assume that corporate earnings continue, as over time they usually do, to grow at about the pace of our economy's expected nominal growth rate of 5 or 6% per year over the coming decade. Footnote: a more than technical caveat. Due to the issuance of additional shares of stock by corporations over the years, the rate of growth of corporate earnings per share is estimated to lag the growth of aggregate corporate earnings by as much as 2 percentage points per year. If that's correct, then the most likely investment return on stocks would be in the range of 7 to 8%. Let's be optimistic and project a return, a bit nervously, of 8%. Second, the present price-earnings multiple on stocks looks to be about 18 times based on the trailing 12-month reported earnings of the Standard & Poor's 500 index, 16 times if we use projected operating earnings, which exclude write-offs for discontinued business activities. If it remains at that level a decade hence, speculative return would neither add to nor detract from that possible 8% investment return. My guess, it is little more than that, is that the PE might ease down to, say, 16 times, reducing the market's return by about 1 percentage point a year to an annual rate of 7%. You don't have to agree with me. If you think it will leap to 25 times, add 3 percentage points, bringing the total return on stocks to 11%. If you think it will drop to 12 times, subtract 4 percentage points, reducing the total return to 4%. If rational expectations suggest future annual return of about 7% on stocks, what do rational expectations suggest about returns on equity funds? Let's assume that 7% is a rational expectation for future stock market returns. Now, let's calculate the return for the average actively managed equity mutual fund in such an environment. Let me remind you of the arithmetic. Nominal return minus costs at past levels minus taxes, reduced to reflect lower capital gains realization, minus an assumed inflation rate of 2.5%, the rate the financial markets are now expecting over the coming decade, equals just 1.2% per year. I simply didn't have the courage to make another deduction to reflect the impact of the counterproductive timing and adverse fund selection that will likely continue to bedevil the typical fund shareholder. It may seem absurd to project such a low return for the typical equity fund investor, but the numbers are there. Again, feel free to disagree and to project the future using your own rational expectations. Let me summarize why the future outlook for stock returns is so far below the long-term real return on U.S. stocks of about 6.5% annually since 1900. My projection of a future real return of 4.5% before costs and taxes is conservative, largely because today's dividend yield of 2% is below the long-term norm of 4.5%, partially offset by my optimistic projection of real earnings growth of 2.5% per year versus the 1.5% long-term norm. Yes, the real long-term rate of per-share earnings growth of U.S. corporations has been no more than that humble figure. In fact, as suggested earlier in this chapter, some experts put the figure at only 1% on an earnings per share basis. In any event, in a future environment of lower returns on equities that I believe is all too likely, the low-cost, tax-efficient index fund would provide even better relative real returns relative to actively managed equity funds than the enormous advantage it achieved over the past quarter century, as illustrated in earlier chapters. Yes, a real 10-year gain of $4,800 on a $10,000 investment in the index fund is nothing to write home about. But what's to be said about the mere $1,300 profit that could well be what the typical managed equity fund delivers? The fact is that lower returns harshly magnify the relentless arithmetic of excessive mutual fund costs, even ignoring all of those unnecessary taxes. Why? While costs of 2.5 percentage points would consume only 16% of a 15% return and only 25% of a 10% return, Such costs would consume nearly 40% of a 7% nominal return and, I hope you're sitting down, nearly 60% of the 4.5% real return on stocks that rational expectations suggest. Unless the fund industry begins to change, reducing management fees, operating expenses, sales charges, and portfolio turnover and its attendant costs, the typical actively managed fund would appear to be a singularly unfortunate investment choice. Clearly, the 1.2% expected annual real return that the average equity fund might deliver is unacceptable. What can equity fund investors do to avoid being trapped by these relentless rules of humble arithmetic, so devastating when applied to future returns that are likely to be well below long-term norms? There are at least these 5 options to improve on it. 1. Select winning funds on the basis of their long-term past records. 2. Select winning funds on the basis of their recent short-term performance. 3. Get some professional advice in selecting funds that are likely to outpace the market. 4. Select funds with rock-bottom costs and minimal portfolio turnover and no sales loads. 5. Select a low-cost index fund that simply holds the stock market portfolio. In the next 5 chapters, we'll examine each of these options. Don't take my word for it. Financial advisors seem to agree with my appraisal of future returns. In the latter part of 2006, in a speech before these professionals at their Chicago convention, I polled the audience. The clear consensus: stock returns of 6.5% over the coming decade. Investment bankers are of a similar mind. When Henry McVeigh, market strategist for Morgan Stanley, polled the chief financial officers of America's 100 largest corporations, they expected a future return on stocks of 6.6%. One wonders how these executives can justify their implicit assumption that the stocks in their company's pension plans will return more than 11% per year. Other highly regarded investment strategists also share my general view that we are facing a new era of subdued investment returns. Gary P. Brinson, CFA, former president of UBS Investment Management, is one whose assessment about future returns echoes my own. Today's investment market fundamentals and financial variables clearly suggest that future real returns from a mixed portfolio of stocks, bonds, and other assets, such as real estate, are unlikely to be greater than 4.5 to 5%. With an inflation assumption of 2.5%, nominal returns greater than 7 to 7.5% for these portfolios are unrealistic. What cannot be explained is why people are willing to pay the considerable fees involved. Perhaps they are paying for historical returns, for hope, or out of desperation. For the markets in total, the amount of value added, or alpha, must sum to 0. One person's positive alpha is someone else's negative alpha. Collectively, for the institutional, mutual fund, and private banking arenas, the aggregate alpha return will be 0 or negative after transaction costs. Aggregate fees for the active managers should thus be, at most, the fees associated with passive management. Yet, these fees are several times larger than fees that would be associated with passive management. This illogical conundrum will ultimately have to end. Or consider these words by Richard M. Ennis, CFA, Ennis Knupp & Associates, and editor of the Financial Analyst Journal. Today, with interest rates near 4% and stocks yielding less than 2%, few among us expect double-digit investment returns for any extended period in the near future. Yet we live with a legacy of that era. Historically high fee structures brought on by trillions upon trillions of dollars seeking growth during the boom and shelter in its aftermath. Second, facing the dual challenge of market efficiency and high costs, investors will continue to shift assets from active to passive management. And third, some of active management's true believers will shift assets from expensive products to more reasonably priced products. Impetus for this move will be the growing realization that high fees sap the performance potential of even skillful managers. Chapter 8. Selecting Long-Term Winners. Don't look for the needle, just buy the haystack. Selecting winning funds in advance is more difficult than it looks. Sure, there are always some winners that survive over the years. And if we pore over records of past performance, it is easy to find them. The mutual funds we hear the most about are those that have lit up the skies with their glow of past success. We don't hear much about those that did well for a while, even for a long while, and then faltered. And when they falter, they often go out of business, consigned to the dustbin of mutual fund history. But easy as it is to select past winners, there is little evidence that performance persists. Let's begin by considering the records of funds that have won over the long term. That seems like a good place to begin, so let's see how it has worked in practice. We'll go back to 1970 and examine the 36-year records of the 355 equity funds that existed all those years ago. The first and most obvious surprise awaits you. Fully 223 of those funds, almost two-thirds, have gone out of business. If your fund doesn't last for the long term, how on earth can you invest for the long term? We can assume that it was not the best performers that have gone to their well-earned demise. The fact is that it was the laggards that disappeared. Sometimes their managers moved on. The average portfolio manager, in fact, lasts just 5 years. Sometimes giant financial conglomerates acquired their management companies, and the new owners decided to clean up the product line. These conglomerates, truth told, are in business primarily to earn a return on their capital, not a return on your, the fund investor's, capital. Often, funds with lagging performance saw their investors flee, and they became a drag on their managers' profits. There are lots of reasons that funds disappear, few of them good. A death in the family, funds that falter, and funds that fail. Even funds with solid long-term records go out of business. Often their management companies are acquired by large marketing companies whose ambitious executives simply conclude that, however good the fund's early records, they are not exciting enough to draw huge amounts of capital from new investors. They have simply outlived their usefulness. In other cases, a few years of faltering performance does the job. Sadly, one of the more recent victims of these attitudes was the second oldest fund in the entire mutual fund industry, one that had survived through all of the tempestuous markets of the past 80 years. State Street Investment Trust, 1925 to 2005. Rest in peace. As one of the longest-serving participants in the fund industry, who clearly remembers the classy record of this fund over so many years, I regard the loss of State Street as a death in the family. In any event, 223 of the equity funds of 1970 are gone, mostly the poor performers. Another 60 remain, yet significantly underperform the S&P 500 by more than 1 percentage point per year. Together, then, 283 funds, nearly 80% of the funds among those original 355, have, one way or another, failed to distinguish themselves. Another 48 funds provided returns within 1 percentage point, plus or minus, of the return of the S&P 500. So let's call them market matchers. That leaves just 24 mutual funds, only 1 out of every 14, that outpace the market by more than 1 percentage point per year. Let's face it, those odds are terrible. What's more, the margin of superiority of 15 of those 24 funds over the S&P 500 was less than 2 percentage points per year, a superiority that may be due as much to luck as to skill. That still leaves us with 9 solid long-term winners. Believe me, it is a tremendous accomplishment to outpace the market by 2 percentage points or more of annual return over 35 years. Make no mistake about that. But here a curious, perhaps almost obvious fact emerges. 6 of those 9 winners achieved their superiority many years ago, often when they were of small size. Years ago, the accomplishments of these 9 successful mutual funds were noticed by investors. Cash poured in, and they got large. But as Warren Buffett reminds us, a fat wallet is the enemy of superior returns. And so it was. As they grew, the records of 6 of them turned lackluster. One fund, in fact, reached its performance peak way back in 1982, 24 long years ago. On balance, it has lagged ever since. 2 others peaked in 1983. The remaining 3 peaked no more recently than 1993, more than a decade ago. One of these was Peter Lynch's legendary Fidelity Magellan Fund, which has now been struggling for 13 years. That leaves just 3 funds. The fact is that only 1 out of every 120 equity funds that started the race in 1970, only 0.8% of the total, have survived and mounted a record of sustained excellence. I now salute them by name: Davis New York Venture, Fidelity Contra Fund, and Franklin Mutual Shares. Hail to the victors! Significantly, while the portfolio managers for these 3 funds have changed over the years, the frequency of change has been tiny. Succeeding his father, Shelby C. Davis, Chris Davis has managed the Davis Fund since 1991. Since 1996 with Kenneth Feinberg. Will Danoff has been the lead manager of Fidelity Contra Fund ever since 1990, and Michael Price managed Franklin until 1997, followed by a successor who ran the fund until 2005. But before you rush out to invest in these 3 funds with such truly remarkable long-term records, think about the next 35 years. Think about the odds that they will continue to outperform. Think about their present size. Think about the fact that within that time frame, they are all virtually certain to have at least several new managers. Think, too, about the odds that these funds will even exist 35 years hence. It's a changing and competitive world out there in mutual fund land, and I wish these managers and the shareholders of the funds they run the very best of luck. Conspicuous by its absence from this list of winning funds, of course, is Legg Mason Value Trust, managed since its 1982 inception by legendary investment professional supreme Bill Miller. Since the fund did not begin operations until 1982, it is not on my list, but it provides several lessons about fund performance. Miller, something of a contrarian, is the only manager in the past 4 decades to outperform the S&P 500 for a truly remarkable 15 consecutive years, 1991 to 2005 inclusive. Despite his great ability, the ever-humble Miller would be, I think, the first to agree with Stephen Jay Gould's tenet that long streaks are extraordinary luck imposed on great skill. Just as was the case with Joe DiMaggio's remarkable 56-game hitting streak in baseball, the longer Miller's streak extended, the more attention it got, and the more investor dollars flowed into the fund. But by the autumn of 2006, his streak seemed destined to come to an end, even as did the streak of the Yankee Clipper. The year is not yet out, so no predictions. With the S&P 500 up 7.3% by September, Legg Mason Value was actually down 4.9%, putting something of a dent in the long-term record. Through 2005, the fund's annual rate of return had averaged 15.3% per year, compared to 12.9% for the S&P 500 Index Fund, a nice annual edge of 2.4 percentage points. But by September 2006, the gap had shrunk to 1.8 percentage points, with an annual time-weighted return averaging 14.6%, compared to 12.8% for the index. Unsurprisingly, the major inflows of investor capital did not begin until 1997, the 7th year of the streak. So the dollar-weighted annual return earned by Legg Mason Value shareholders was a sharply lower 10.3% that was far below its time-weighted return and also well below the index return. Is Miller's reversion toward and then below the market mean temporary or enduring? Will the fund be afflicted with the same malaise that afflicted 6 of those 9 long-term winners we just discussed? Or is it merely a brief interval of bad luck? Who can know? Whatever the case, please remember that the odds in favor of owning a consistently successful equity fund were less than 1 out of 100. However one slices and dices the data, there can be no question that funds with long-serving portfolio managers and records of consistent excellence are the exception rather than the rule in the mutual fund industry. The simple fact, using Cervantes' wonderful observation, selecting a mutual fund that will outpace the stock market itself over the long term is like looking for a needle in the haystack. I offer you Bogle's corollary. Don't look for the needle in the haystack. Just buy the haystack. The haystack, of course, is the entire stock market portfolio, readily available through a low-cost index fund. The return of such a fund would have roughly matched or exceeded the returns of 346 of the 355 funds that began the 35-year competition that I described at the start of this chapter. And I see no reason that the same fund cannot achieve a roughly commensurate achievement in the years to come. Not through any legerdemain, but merely through the relentless rules of humble arithmetic that you now must know so well. We know that the index fund will deliver substantially all of the stock market's return, but with all the fund manager changes that will inevitably be forthcoming for actively managed funds, with all the funds that will die, with the successful funds drawing capital in amounts that will preclude their future success, and with our inability to be certain how much of a fund's performance is based on luck and how much on skill, there is simply no way to assure success by picking the funds that will best suit us, even by looking to their past performance over the long term. In fund performance, the past is rarely prologue. Don't take my word for it. Need more advice? With his customary wisdom, Paul Samuelson sums up the difficulty of selecting superior managers in this parable. Suppose it was demonstrated that 1 out of 20 alcoholics could learn to become a moderate social drinker. The experienced clinician would answer, even if true, act as if it were false, for you will never identify that 1 in 20, and in the attempt, 5 in 20 will be ruined. Investors should forsake the search for such tiny needles in huge haystacks. In the Wall Street Journal, longtime Getting Going columnist Jonathan Clements asks, "Can you pick the winners?" The answer: even fans of actively managed funds often concede that most other investors would be better off in index funds. But buoyed by abundant self-confidence, these folks aren't about to give up on actively managed funds themselves. A tad delusional? I think so. Picking the best performing funds is like trying to predict the dice before you roll them down the craps table, says an investment advisor in Boca Raton, Florida. I can't do it. The public can't do it. Still, I figure we shouldn't discourage fans of actively managed funds. With all of their buying and selling, active investors ensure the market is reasonably efficient. That makes it possible for the rest of us to do the sensible thing, which is to index. Want to join me in this parasitic behavior? To build a well-diversified portfolio, you might stash 70% of your stock portfolio in a Wilshire 5000 index fund and the remaining 30% in an international index fund. If these comments don't persuade you about the hazards of focusing on past returns of mutual funds, just believe what fund organizations tell you. Every single firm in the fund industry acknowledges my conclusion that past fund performance is of no help in projecting the future returns of mutual funds. In every mutual fund prospectus, in every sales promotional folder, and in every mutual fund advertisement, albeit in print almost too small to read, the following warning appears. Past performance is no guarantee of future results. Believe it. Chapter 9. The Futility of Chasing Short-Term Performance. Fooled by Randomness. The title of a provocative book by Nassim Nicholas Taleb. In selecting mutual funds, however, most fund investors seem to rely not on sustained performance over the long term, but on exciting performance over the short term. Chapter 5 reinforces this point. Studies show that 95% of all investor dollars flow to funds rated 4 or 5 stars by Morningstar, the statistical service most broadly used by investors in evaluating fund returns. These star ratings are based on a composite of a fund's record over the previous 3, 5, and 10-year periods. For younger funds, the ratings may cover as few as 3 years. As a result, the previous 2 years' performance alone accounts for 35% of the rating of a fund with 10 years of history, and 66% for a fund in business for from 3 to 5 years, a heavy bias in favor of recent returns. How successful are fund choices based on the stars awarded on the basis of such short-term achievements? Not very. According to investment analyst Mark Holbert, a mutual fund portfolio continuously adjusted to hold only Morningstar's 4 and 5-star funds earned an annual return of just 6.9% during 1994 to 2004, nearly 40% below the 11% return on the total U.S. stock market index. In fairness, Morningstar changed the basis for its rating system to reflect performance versus peers with similar objectives rather than funds as a group. The relative performance of the 4 and 5-star funds has improved since then. To make matters worse, according to Holbert, these highly rated funds were assuming even more risk than the market itself. Average monthly volatility in asset value, 16% for the funds compared to 15% and a much smaller cost than is typified equity mutual funds. As a result, we've given actively managed funds the benefit of a very large doubt. Result: over 1 year, about 29% active managers on average would be expected to outpace the index. Over 5 years, about 15% would be expected to win. Over 10 years, 9%. Over 25 years, 5%. And over 50 years, just 2% of active managers would be expected to win. How will the future actually play out? Of course, we can't be sure. But we know what the past 25 years looked like, and we know that over the past 35 years, only 9 of the 355 funds in business at the outset were able to outperform the stock market index by more than 2% per year. What's more, even the majority of these winners lost their early edge a decade or more ago. So it looks like our statistical odds are in the right ballpark. Thus, it seems clear that stock index funds deserve an important place in your portfolio, even as they constitute the overriding portion of my own. Whatever the case, in the era of subdued returns that most likely lies in prospect, fund costs will become more important than ever. Even more so when we move from the illusion that mutual funds as a group can capture whatever returns our financial markets provide to the even greater illusion that most mutual fund investors can capture even those depleted returns in their own fund portfolios. So what the index fund has going for it is, as I have often said, the magic of simplicity in an empire of parsimony. So let me reiterate. Don't ever forget all of those pesky costs. Fund expense ratios, sales charges, and turnover costs, tax costs, and the most subtle cost of all, the cost of living. The rising cost of living, which we describe as inflation, is virtually guaranteed to substantially erode the spending power of our investments over time. Also, don't ever forget that only in the rarest cases do fund investors succeed in capturing the returns that the funds themselves report. My conclusions about the market returns we can expect in the years ahead, as well as my conclusions about the share of those returns that funds will capture, and the share of those returns that we investors will actually enjoy, have one thing in common. They rely not on opinion, but largely on mathematical facts, the relentless rules of humble arithmetic, the very same rules that make selecting winning funds rather like looking for a needle in a haystack. Only at your peril should you ignore these rules. If, as I said at the outset, the road to investment success is hazardous, filled with dangerous turns and giant potholes, never forget that simple arithmetic can enable you to moderate those turns and avoid those potholes. So do your best to diversify to the nth degree. Minimize your investment expenses. and focus your own emotions where they cannot wreak the kind of havoc that they create in most investment programs. Rely on your own common sense. Emphasize all stock market index funds. Carefully consider your risk tolerance and the portion of your investments you allocate to equities. Then, stay the course. I should add, importantly, that all index funds are not created equal. While their index-based portfolios are, of course, substantially identical, their costs are anything but identical. Some have minuscule expense ratios. Others have expense ratios that surpass the bounds of reason. Some are no-load funds. Nearly a third, as it turns out, have substantial front-end loads, often with an option to pay those loads over a period of usually 5 years. Others entail the payment of standard brokerage commission. Today, there are some 115 index mutual funds designed to track the S&P 500 index. Astonishingly, more than half of them carry an initial sales load, albeit often concealed by offering Class B shares with no front-end load but an extra heavy annual fee used to pay the broker. The wise investor will be sure to select only those index funds that are available without sales loads and those operating with the very lowest costs. These costs, no surprise here, are directly related to the net returns delivered to the shareholders of these funds. In the past, some 500 index-based funds may have earned small increases in return or been penalized by small reductions based on their manager's ability or inability to employ strategies that allow small short-term departures from the exact weightings of the stocks in the index. I assume, however, that these variations will be lower in the future and have therefore ignored them as an element in the cost-value equation. Funds tracking a particular index are, or should be, commodities in terms of their portfolios and the returns they provide. So variations in costs make the difference. While cost differentials may look trivial when expressed on an annual basis, compounded over the years, they make the difference between investment success and failure. Profit earned in Index 500 Fund A, $99,100. In Index Fund B, $122,700. All index funds are not created equal. Let's go back to January 1984, for example, when the second index fund was formed, Wells Fargo Equity Index Fund, and compare its subsequent return with that of the original Vanguard Index Fund over the same period. Both funds selected the S&P 500 index as their benchmark. The Vanguard Index 500 carried no initial sales commission and operated with an expense ratio averaging 0.28% annually. By 2005, the ratio had decreased to 0.18% and to 0.09% for longer-term investors and those who had $100,000 or more invested in the fund. The Wells Fargo Fund, on the other hand, carried an initial sales charge of 5.75%, and its expense ratio averaged 0.8% per year, 0.64% in 2005. These seemingly small differences added up to a 23% enhancement in value for the Vanguard Fund. An original investment of $10,000 in each produced a profit of $122,700 for the Vanguard 500 Index Fund, compared to $99,100 for the Wells Fargo Equity Index Fund. All index funds are not created equal. Intelligent investors will select the lowest cost index funds that are available from reputable fund organizations. Your fund should be your cash cow, not the manager's. Some years ago, a Wells Fargo representative was asked how the firm could justify such high charges. The answer? You don't understand. It's our cash cow. That is, it generates lots of profits to the manager. By carefully selecting the lowest cost index funds for your portfolio, you can be sure that the fund is not the manager's cash cow, but your own. Given my preference for the all-market index fund, I almost hesitate to tell you that, since that lonely first S&P index was formed in 1975, a staggering total of another 578 more index funds are now in operation. So investors now face a mind-boggling set of confusing choices: large cap, mid cap, small cap, industry sectors, international, single country, and so on. To make it even more confusing, indexing works like a charm in every one of these areas. An index fund is inevitably destined to surpass the returns earned by the other investors in the market segment tracked by its index. Even though we never have complete information about the precise returns earned by investors as a group in each segment, given the relentless rules of humble arithmetic, it must work that way. Standard & Poor's Corporation now compares index returns with actual returns achieved by active managers in a whole variety of U.S. market segments, and the results are unmistakable. Over the past 5 years alone, the S&P 500 index has outpaced 67% of large-cap general equity funds, while the S&P Mid-Cap 400 index has outperformed 84% of mid-cap funds, and the S&P Small-Cap 600 index has outperformed 79% of all small-cap funds. Remarkable but unsurprising. While these comparisons, sorted by number of funds rather than by fund assets, have the flaws noted earlier, the message could hardly be clearer. Indexing is the winning strategy. It's worth noting that Standard & Poor's attempts to take survivor bias into account in its calculations. Interestingly, during the past 5 years alone, an astonishing 28% of all general equity funds have gone out of business. That's one more warning about relying on actively managed mutual funds as long-term investments. While it is alleged that indexing doesn't work in less efficient markets, that is, outside of the S&P 500, the impressive performance of the small and mid-cap index suggests that it works perfectly well, as it must. For whether markets are efficient or inefficient, as a group, all investors in that segment earn the return of that segment. Yes, in markets that are inefficient, the most successful managers may achieve unusually large returns. But never forget that as a group, all investors in any discrete segment of the stock market must be, and are, average. For each big success, there must also be a big failure. But after all those deductions of even larger management fees and the damaging impact of the even larger turnover costs that funds incur in less efficient markets, the aggregate lag widens. So even in individual market segments, index funds, with their tiny costs, win again. International funds are also subject to the same allegations that it is easier for managers to win in supposedly less efficient markets, but also to no avail. S&P reports that the international index, world markets less U.S. stocks, outpaced 80% of actively managed international equity funds over the past 5 years. Similarly, the S&P Emerging Markets Index outpaced 88% of emerging market funds. I'm not sure what additional data are required to make the case for indexing. But while investing in particular market sectors is done most efficiently through index funds, betting on the winning sectors is exactly that, betting. And emotions, once again, are almost certain to have a powerful negative impact on the returns the investors achieve. Whatever returns each sector itself may earn, the investors in those very sectors will likely, if not certainly, fall well behind them. For there is abundant evidence that the most popular sector funds of the day are those that have recently enjoyed the most spectacular recent performance, and that such after-the-fact popularity is a recipe for unsuccessful investing. For example, when Vanguard created the industry's first growth index and value index funds in 1992, the former was designed for younger investors focused on wealth accumulation, seeking tax efficiency, and willing to assume larger risks. The latter was designed for older investors, focused on wealth preservation, seeking higher income, and happy to reduce their risks. Alas, while the original idea was strong, the ensuing reality was weak. What followed their introduction was as crystal clear an example of classic performance chasing as one could imagine. During the 1993 to 1997 period, the stock market was relatively placid, and value stocks and growth stocks delivered similar returns. Then, in the new economy bubble, growth stocks took off, earning a cumulative return by 2000 that left value stocks in the dust. 1992 to March 2000, growth index total return 364%, value index total return 229%. Après-moi le déluge. Reversion to the mean took hold, and growth stocks plummeted through 2002. Investor interest in the two fund styles was well balanced during the early years. But in the bubble that followed, investors poured $11 billion into the soaring growth index fund, nearly 4 times the $3 billion invested in the sedate value index fund. Then, in the aftermath, investors switched their loyalty, with net redemptions of $850 million in the growth fund during 2001 to 2006, and net purchases approaching $2 billion in the value fund. Since 1993, the two funds have achieved substantial positive returns on a standard time-weighted basis, 9.1% per year for growth and 11.2% for value. With their counterproductive timing and selection, however, investors in these index funds have not come even close to matching those returns. The average dollar-weighted return of investors in the growth index fund was a pathetic 0.9% per year. While investors in the value index fund did better, their return of 7.6% still lagged the return of the value index itself by 3.6 percentage points per year. Since 1993, the cumulative return of the growth index has been 224% versus 320% for the value index, based on the traditional calculation of fund performance. The growth index fund investor, meanwhile, earned but 13%, and the value index fund investor earned about 170%. Despite my best intentions when they were formed, Vanguard's growth and value index funds proved to be a paradigm for the ways that investors fool themselves, relinquishing perfectly acceptable long-term returns in their search to find the holy grail of extra returns in the short run. So look before you leap in trying to pick which market sector to bet on. It's not as exciting, but owning the classic stock market index fund is the ultimate strategy. It holds the mathematical certainty that marks it as the gold standard in investing, and the alchemists of active management cannot turn their own lead or copper or iron into gold. Just avoid complexity, rely on simplicity, take costs out of the equation, and trust the arithmetic. Don't take my word for it. If you think that my calculation of the odds that only 2% of all equity mutual portfolios will outperform the stock market over 50 years are too pessimistic, consider the odds calculated by Michael J. Mauboussin, Chief Market Strategist at Legg Mason, Adjunct Professor at Columbia Business School, and author of the best-selling More Than You Know. While my 2% estimate would mean that one portfolio in 50 would outperform the stock market, Mauboussin calculates the odds at 1 in 223,000. Either way, the odds of outpacing an all-market index fund are, well, terrible. Now listen to Warren Buffett's widely esteemed partner, Charlie Munger, who eloquently states the case for shunning the foolish complexity of investing and opting for simplicity. At large charitable foundations in recent years, there has been a drift toward more complexity. Some foundations have tried to become much better versions of Bernie Kornfeld's Fund of Funds. In some funds, there are not few but many investment counselors, chosen by an additional layer of consultants who are hired to decide which investment counselors are best, help in allocating funds to various categories, ensure that claimed investment styles are scrupulously followed, plus a third layer of the security analysts employed by investment banks. There is one thing sure about all this complexity: the total cost of all the investment management, plus the frictional costs of fairly often getting in and out of many large investment positions, can easily reach 3% of foundation net worth per annum. All the equity investors in total will surely bear a performance disadvantage per annum equal to the total croupier's costs that they have jointly elected to bear. And it is unescapable that exactly half of the investors will get a result below the median result after the croupier's take, a median result that may well be somewhere between unexciting and lousy. The wiser choice is to dispense with the consultants and reduce the investment turnover by changing to indexed investment in equities. Chapter 13. Bond Funds and Money Market Funds. The relentless rules repeat, even more powerfully. So far, all of our discussion about the index fund and its handmaiden, low investment costs, has related to the stock market and to equity mutual funds. But the relentless rules of humble arithmetic with which I've regaled you also apply, arguably even more forcefully, to bond funds and money market funds. Perhaps it's obvious why this is so. While a seemingly infinite number of factors influence the stock market and each individual stock that is traded there, a single factor influences the bond market and the money market, and for that matter, each individual fixed income security, far more than any other: the prevailing level of interest rates. Managers of fixed income funds can't do much, if anything, to influence rates. If they don't like the rates established in that market, calling the Treasury Department or the Federal Reserve, or otherwise trying to change the supply and demand equation, is unlikely to bear fruit. So let's be clear. In the long run, virtually 100% of the return on any bond fund or money market fund is accounted for by the net interest income it generates for its shareholders. The only way for a manager to add an increment to that return is to make interest rate bets. For example, selling bonds when the market expects rates to go up and prices down, and then buying bonds when the reverse is expected to happen. If you think that picking stocks and timing their purchase is hard, just imagine how hard it is to execute these same strategies successfully in the incredibly efficient precincts of the bond market. Thus, managers of fixed income funds will almost inevitably deliver an investment return that parallels the baseline constituted by the interest rate environment. Yes, a few managers might do better, even do better for a long time, by being extra smart or extra lucky, or by taking extra risk. Yet even the best bond and money market managers can add only a few fractions of 1% per year to your long-term returns, albeit only by risking a comparable shortfall. What's more, even if these margins are achieved, they rarely overcome the fees, sales loads, and expenses involved in acquiring their services. While these costs make the task of adding returns far more difficult, overly confident bond fund managers may be tempted to take just a little extra risk by extending maturities of the bonds in the portfolio. Long-dated bonds, say 30 years, are much more volatile than short-term bonds, say 2 years, but usually provide higher yields. They are also tempted to reduce the investment quality of the portfolio, holding less in U.S. Treasury bonds, rated AAA, or in investment-grade corporate bonds, rated BBB or better, and holding more in below investment-grade bonds, BB or lower, or even some junk bonds, rated below CC, or even unrated. Since stocks represent the residual ownership or equity of corporations, we don't usually associate the word safety with them. Unlike bonds, stocks can't default. Bonds, on the other hand, represent debt. If the payments of interest that corporations and governments promise to make every 6 months are threatened, their ratings will be downgraded and their market values reduced. And if they finally fail to make the promised payments, they enter bankruptcy proceedings. Where bonds are concerned, Brandeis's warning becomes particularly meaningful. Remember, O stranger, arithmetic is the first of the sciences and the mother of safety. There are too many types of bond funds to try your patience by examining all of them. So let's examine the 3 basic maturity levels that have become the industry standard, one in each of the 3 major bond segments: taxable, corporate and government bonds, tax-exempt municipal bonds, and U.S. Treasury bonds. We'll begin with intermediate-term taxable bond funds, then turn to long-term tax-exempt bond funds, and then evaluate funds investing in short-term U.S. Treasury notes. As you'll see, the low-cost intermediate-term bond index fund is a truly superior performer. This finding should no longer surprise you. Footnote: I apologize, sort of, for using Vanguard funds for the examples of the market indexes. But there are few other bond funds in these categories using index or index-like strategies, and literally none with lower costs. With a 10-year return averaging 6.8% annually, it comes within a whisper of outpacing the cost-adjusted return of the comparable Lehman 5 to 10-year government corporate bond index. What is more, the index fund's annual return of 6.8% was almost 25% higher than the 5.5% return of its average peer. While the actively managed bond funds as a group earned a lower gross return than either the index fund or the index, relative cost proved to be the principal differentiator in net return. As a group, the portfolios of the actively managed bond funds include about 25% corporate and 75% U.S. government bonds, largely bonds of government agencies, while the bond index and the bond index fund include about 50% in corporates and 50% in governments. While the bond index fund carried slightly more volatility risk, with an annualized standard deviation of 5% versus 3.7% for the active managers, both figures represent an extremely low risk level. And so the message echoes. In intermediate-term taxable bond funds, in terms of maximizing your return and minimizing your risk, the low-cost index fund is truly a superior performer. The Vanguard Intermediate Term Bond Index Fund, for example, has an expense ratio of 0.18%, less than 1/5 of the 1% expense ratio of its average peer. In addition, its return benefits from the absence of sales loads. Always avoid bond funds with sales loads. A typical 5% load, for example, would obliterate your entire yield for the first year. With a cumulative final value of an initial investment of $10,000 growing to $19,289 in the index fund, versus just $17,081 for its average rival, the index strategy is a winning strategy, outpacing an amazing 550 of its 570 peers over the past decade. In long-term tax-exempt bond funds, once again, indexing wins. Now let's consider long-term maturities and turn our attention to tax-exempt municipal bond funds. Because of complexities in the construction of municipal bond indexes, there are no pure index funds in this category. But the results of the major index in the field, the Lehman Brothers Tax-Exempt 10-Year Maturity Index, confirm the power of indexing in surpassing the returns provided by the average active bond manager. Since the index itself provided a gross return of 5.93%, a comparable index fund, after assumed costs of 0.2%, would have provided a 5.73% net annual return. By way of comparison, the Vanguard Long-Term Tax-Exempt Bond Fund, whose expense ratio of 0.15% is actually slightly below these assumed costs for the index fund, provided a net return of 5.85%, a bit higher even than the assumed return of the bond index fund. Like the index fund, this bond fund is broadly diversified, holds a high-quality portfolio, 87% rated A or better, even higher than its actively managed peers, and minimizes turnover. Once again, low costs lead to higher returns. The 5.73% annual return of the hypothetical municipal bond index fund was roughly 15% more than the 5% earned by the average long-term municipal fund, even though the actively managed funds were assuming higher risks, 15% in lower-rated bonds versus 4% for the index and 13% for the Vanguard fund. Over the past decade, $10,000 initially invested in the Vanguard Long-Term Municipal Bond Fund grew to $17,657 versus $16,306 for its average rival. Again, with low costs, broad diversification, and no serious attempt to outguess the market in long-term tax-exempt bond funds, once again, indexing wins. Its close proxy, the Vanguard Long-Term Municipal Bond Fund, ranks first among its 194 peers. In short-term Treasury funds, the lowest cost option wins again. Our sweep of the bond fund arena concludes with an examination of short-term funds investing in U.S. Treasury obligations. There are few surprises here. The net return earned by the index itself, 5.06% per year, adjusted for an assumed expense ratio of 0.2%, outpaces the average fund. Again, while the Vanguard Short-Term Government Bond Fund is not, technically speaking, an index fund as such, it tracks the index return with remarkable precision, turning in a net average annual return of 5.06% over the past decade. The lowest cost options win again, outpacing 97 of the 122 short-term government funds. Treasuries being treasuries, investment quality is virtually uniform. Both the Vanguard Index Fund and the index itself hold 100% of their portfolios in short-term U.S. Treasury notes, and the active funds hold 99%. With its towering 0.92% average expense ratio, the average bond fund has a lot to overcome. It doesn't succeed, it really can't succeed, in overcoming that handicap. What's more, the index and the Vanguard Fund displayed slightly less volatility than their active peers. Again, many of these funds carry sales charges averaging 3%, which are incorporated into the average return. The tracking of its benchmark, its quality parity, and its extremely low expenses clearly mark the Vanguard Short-Term Treasury Bond Fund as the functional equivalent of the Lehman 1 to 5 year government bond index. While there are no bond funds that track this index, the Vanguard Fund is the virtual equivalent of an index fund. Both provided cumulative gains on an initial investment of $10,000 of $16,382, compared to $15,588 for the average short-term Treasury fund. In money market funds, surprise, low cost wins yet again. Money market funds can be thought of as very short-term bond funds with uniformly high credit quality. Federal regulations limit money market funds to high-grade commercial and bank paper, and as a practical matter, limit maturities to the very short term, about 60 days, in order to maintain a stable asset value of $1 per share. Unlike bank savings accounts, money market funds are not guaranteed by the Federal Deposit Insurance Corporation. As a result, money market funds hold portfolios with generally similar quality, though there is often a bit of stretching for yield going on, and very short maturity, usually averaging about 40 days. As a result, they tend to earn substantially identical gross yields on their portfolios. With their short maturities, extremely high credit quality, and broadly diversified portfolios, money market funds too essentially become commodities. That is, when all else is equal, as it is here, what determines relative performance is relative cost. So, just as in stock index funds and in bond index funds, cost tells virtually the entire story in money market funds. Indeed, if we rank the records of the 190 money market funds in terms of the returns they have delivered to investors over the past 10 years, highest first, and then compare their expense ratio, lowest first, the relationship is almost perfect. Vanguard Prime Money Market Fund, close cousin to our hypothetical index fund, carries the day, producing a net annual return of 3.77% for the past decade, some 15% above the return on the average money market fund. Cumulatively, a $10,000 initial investment in the Vanguard Prime Money Market Fund grew to $14,478 over the past decade, versus $13,785 for its average peer. Among 190 comparable funds, it ranked number 7. Remarkably, money market funds in the high-cost quartile earned a gross return of 4.1%, about equal to the average, of course. But with a shocking annual expense ratio of 1.39%, these high-cost funds delivered a net return of just 2.71% to their owners. Why would investors ever pay more than a 0.5% annual cost for a money market fund? The answer is beyond me. They should probably have their heads examined. How the supposedly independent directors of these 45 money funds with expense ratios at or above the 1% level could vote to approve such fees is an even bigger question. Their job is to represent the interest of the fund shareholders, and they have failed. But intelligent investors don't need to fail. If you avoid these high-cost money market funds in favor of low-cost funds, success will inevitably follow. I realize full well that investors are far more focused on equity funds and the stock market than on fixed income funds. Nonetheless, smart investors will save themselves lots of money and substantially improve their returns if they apply the principles of broad diversification, low cost, no load, minimal turnover, and long-term investing, the very characteristics that enable index funds to guarantee you your fair share of the returns in the bond and money markets, even as they do in all financial markets. Don't take my word for it. While not a lot has been written about the remarkable and remarkably obvious value of index funds that invest in bonds, the convictions that I express in this chapter have been strongly reinforced by Walter R. Good, CFA, and Roy W. Hermanson, CFA, in Index Your Way to Investment Success. Comparison of expenses, transaction costs, and, where applicable, sales loads identify the cost advantage for bond index funds. For the purposes of projecting returns, let's assume that the actively managed fund and the benchmark index fund each hold bonds that, overall, yield the same 7% annual rate of return. For the actively managed load funds, the index fund advantage amounts to 1.2 percentage points per year. The data provide a sobering glimpse of the challenge encountered by the active bond fund manager and suggest how much additional return active management may have to add, on average, over an extended period, just to break even. Near-index bond mutual funds provide an alternative to indexing the bond market. While the funds do not completely conform to the index fund model, they share key characteristics: very high degree of diversification in the specified market segment, very low expense ratio, very low transaction costs, and absence of sales loads. Once again, further confirmation comes from across the pond. England's Timothy Hale, author of Smarter Indexing, Simpler Decisions for Better Results, writes, "You should not overlook the efficacy of index investing for bonds, which up to now has been whispered rather than shouted from the rooftops. The evidence is compelling and comes down firmly in favor of investing in index funds. Over the 10-year period, 1988 to 1998, U.S. bond index funds returned 8.9% a year against 8.2% for actively managed bond funds, with index funds beating 85% of all active funds. This differential is largely due to fees." Chapter 14. Creating Indexes That Beat the Market. The New Paradigm. Since the inception of the first index mutual fund in 1975, indexing, investing in passively managed, broadly diversified, low-cost stock and bond index funds, has proved to be both a remarkable artistic success and a remarkable commercial success. In previous chapters, we described the artistic success of index funds in providing returns to investors that have vastly surpassed the returns achieved by investors in actively managed mutual funds. Given that record, the commercial success of indexing is hardly surprising. Today, most indexed assets are concentrated in classic index funds, representing the broad U.S. stock market, the S&P 500 or the Dow Jones Wilshire 5000, the broad international stock market, the Morgan Stanley EAFE, Europe, Australia, and Far East Index, the broad international stock market, and the broad U.S. bond market. But a whole variety of market sector index funds has also sprung up, based on indexes of growth stocks, value stocks, mid and small cap stocks, and a variety of other discrete market segments. Any market segment that can be accurately defined and measured and made available to investors as a group can be easily indexed. Assets of the traditional classic stock index funds have grown from $16 million in 1976 to $445 million in 1986, to $68 billion in 1996, to $369 billion in 2006. 7% of the assets of all equity mutual funds. Assets of bond index funds have also soared, from $132 million in 1986 to $6 billion in 1996, to $62 billion in 2006. 7% of the assets of all corporate and treasury bond funds. Indexing has become a competitive field. Managers of the classic index funds are engaged in a fiercely competitive price war, cutting their expense ratios to draw the assets of investors who are smart enough to realize the price is the difference. This trend is great for index fund investors, but it slashes profits to index fund managers and discourages entrepreneurs who start new fund ventures in the hopes of enriching themselves by building fund empires. So how can promoters take advantage of the proven attributes that underlie the success of the index fund? A tracking portfolio that affords broad diversification, is passively managed, and offers lower costs than actively managed mutual funds. Why, create new indexes, and then claim that they will consistently outpace the broad market indexes that up until now have pretty much defined how we think of indexing. Traditional indexes, as noted in Chapter 3, are cap-weighted. That is, the weight of each stock or bond in the index portfolio is determined by its market capitalization. For the total U.S. stock market, that value is $15 trillion, representing the collective investment of all stockholders of U.S. equities. Remember the Gottrocks family, whom you met in Chapter 1? So it follows that, together, all investors as a group earn precisely the market's return. As you now surely realize, if the market rises by 10%, all investors as a group earn 10%, before costs, of course. So the miracle, as it were, of the index fund is simple arithmetic. By minimizing all of those costs of investing, it guarantees that its participants will earn higher net returns than all of the other participants in stock ownership as a group. This is the only approach to equity investing that can guarantee such an outcome. The only way to beat the market portfolio, obviously, is to depart from the market portfolio. And this is what active managers strive to do, individually. But collectively, of course, they can't succeed. For their trading merely shifts ownership from one holder to another. All of that swapping of stock certificates back and forth, however it may work out for a given buyer or seller, enriches only our financial intermediaries. But the money manager, in effect, puts forth this argument. I'm smarter than the others in the market. I can discover undervalued stocks, and when the market discovers them and they rise in price, I'll sell them. Then I'll discover other undervalued stocks and repeat the process all over again. I know that the stock market is highly efficient, but through my intelligence, my expert analysts, my computer programs, and my trading strategies, I can spot temporary inefficiencies and capture them over and over again. As we have seen in Chapter 8, some fund managers have actually succeeded in this task, but they are precious few in number. Over the past 36 years, just 3 funds out of 355, 0.8%, have consistently distinguished themselves. Nonetheless, hope springs eternal among money managers, and they strive for excellence. Of course, they believe in themselves. This field has few shrinking violets. But they also have a vested financial interest in persuading investors that if they have done well in the past, they will continue to do so. And if they haven't done well in the past, well, better days are always ahead. But in recent years, something new has been added to the mix. Financial entrepreneurs who believe, I'm sure sincerely, if with a heavy dollop of self-interest, that they can create indexes that will beat the market. Interesting. They have developed new methods of weighting portfolio holdings that they vow will outperform the traditional market cap-weighted portfolio that represents the holdings of investors as a group. This new breed of indexers, not in fact indexers but active strategists, focuses on weighting portfolios by so-called fundamental factors. Rather than weighting by market cap, they use a combination of factors such as corporate revenues, cash flows, profits, or dividends. For example, the portfolio is weighted by the dollar amount of dividends distributed by each corporation, rather than the dollar amount of its market capitalization. They argue, fairly enough, that in a cap-weighted portfolio, half of the stocks are overvalued to a greater or lesser extent, and half are undervalued. The traditional indexer responds, "Of course, but who really knows which half is which?" The new fundamental indexers unabashedly answer, "We do." They claim to know which is which. And, this will not surprise you, the fundamental factors they have identified as the basis for their portfolio selections Audio Renaissance presents The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns, by John C. Bogle. Read for you by Tom Pinto. Dedication. Dedicated to Paul A. Samuelson, Professor of Economics at Massachusetts Institute of Technology, Nobel Laureate, Investment Sage. In 1948, his classic textbook introduced me to economics as a student at Princeton University. In 1974, his writings reignited my interest in market indexing as an investment strategy. In 1976, his Newsweek column applauded my creation of the world's first index mutual fund. In 1993, he wrote the foreword to my first book, and in 1999, he provided a powerful endorsement for my second. Now in his 92nd year, he remains my mentor, my inspiration, my shining light. Introduction. Don't allow a winner's game to become a loser's game. Let's start from the beginning. What is an index fund? It is simply a basket, portfolio, that holds many eggs, stocks, designed to mimic the overall performance of any financial market or market sector. Footnote. Please keep in mind that an index may also be constructed around bonds in the bond market, or even road less traveled asset classes such as commodities or real estate. Today, if you wish, you could literally hold all of your wealth in a diversified set of index funds representing asset classes within the U.S. or the global economy. Classic index funds, by definition, basically represent the entire stock market basket, not just a few scattered eggs. Such index funds eliminate the risk of individual stocks, the risk of market sectors, and the risk of manager selection, with only stock market risk remaining, which is quite large enough, thank you. Index funds make up for their lack of excitement by their truly remarkable long-term productivity. This is much more than a book about index funds. It is a book that is determined to change the very way that you think about investing. For when you understand how our financial markets actually work, you will see that the index fund is indeed the only investment that guarantees that you will capture your fair share of the returns that American business earns. Thanks to the miracle of compounding, the accumulations of wealth over the years generated by those returns have been little short of fantastic. I'm speaking here about the classic index fund, one that is broadly diversified, holding all or almost all of its share of the $15 trillion capitalization of the U.S. stock market, operating with minimal expenses and without advisory fees, with tiny portfolio turnover, and with high tax efficiency. The index fund simply owns corporate America, buying an interest in each stock in the stock market in proportion to its market capitalization and then holding it forever. Please don't underestimate the power of compounding the generous returns earned by our businesses. Over the past century, Our corporations have earned a return on their capital of 9.5% per year. Compounded at that rate over a decade, each $1 initially invested grows to $2.48. Over 2 decades, $6.14. Over 3 decades, $15.22. Over 4 decades, $37.72. And over 5 decades, $93.48. Footnote: these accumulations are measured in nominal dollars, with no adjustment for the long-term decline in their buying power, averaging about 3% a year since the 20th century began. If we use real inflation-adjusted dollars, the return drops from 9.5% to 6.5%. As a result, the accumulations of an initial investment of $1 would be $1.88, $3.52, $6.61, $12.42, and $23.31 for respective periods. The magic of compounding is little short of a miracle. Simply put, thanks to the growth, productivity, resourcefulness, and innovation of our corporations, capitalism creates wealth, a positive-sum game for its owners. Investing in equities is a winner's game. The returns earned by business are ultimately translated into the returns earned by the stock market itself. I have no way of knowing what share of these returns you have earned in the past, but academic studies suggest that if you are a typical investor in individual stocks, your returns have probably lagged the market by about 2.5 percentage points per year. Applying that figure to the annual return of 12% earned over the past 25 years by the Standard & Poor's 500 stock index, your annual return has been less than 10%. Result: your slice of the market pie, as it were, has been less than 80%. To make matters worse, as you will see in Chapter 5, if you are a typical investor in mutual funds, you've done even worse. If you don't believe that is what most investors experience, think for a moment, please, about the relentless rules of humble arithmetic. These iron rules define the game. As investors, all of us as a group earn the stock market's return. As a group, I hope you're sitting down for this astonishing revelation, we are average. Each extra return that one of us earns means that another of our fellow investors suffers a return shortfall of precisely the same dimension. Before the deduction of the cost of investing, beating the stock market is a zero-sum game. But the costs of playing the investment game both reduce the gains of the winners and increases the losses of the losers. So who wins? You know who wins. The man in the middle. Actually, the men and women in the middle. The brokers, the investment bankers, the money managers, the marketers, the lawyers, the accountants, the operations departments of our financial system, is the only sure winner in the game of investing. Our financial croupiers always win. In the casino, the house always wins. In horse racing, the track always wins. In the trifecta lottery, the state always wins. Investing is no different. After the deduction of the cost of investing, beating the stock market is a loser's game. Don't allow a winner's game to become a loser's game. Yes, after the costs of financial intermediation, all those brokerage commissions, portfolio transaction costs, and fund operating expenses, all those investment management fees, all those advertising dollars, and all those marketing schemes, and all those legal costs and custodial fees that we pay day after day and year after year, beating the market is inevitably a game for losers. No matter how many books are published and promoted purporting to show how easy it is to win, investors fall short. Indeed, when we add the cost of these self-help investment books into the equation, it becomes even more of a loser's game. The wonderful magic of compounding that is reflected in the long-term returns earned by American business, then, is translated into equally wonderful returns in the stock market. But those returns are overwhelmed by the powerful tyranny of compounding the costs of investing. For those who choose to play the game, the odds in favor of the successful achievement of superior returns are terrible. Simply playing the game consigns the average investor to a woeful shortfall to the returns generated by the stock market over the long term. Most investors in stocks, of course, think that they can avoid the pitfalls of investing by due diligence and knowledge, trading stocks with alacrity in order to stay one step ahead of the game. But the fact is that while the investors who trade the least have a fighting chance of capturing the market's return, those who trade the most are doomed to failure. For example, an academic study showed that the most active 1/5 of all stock traders turn their portfolios over at the rate of more than 21% per month. While they earned the market return of 17.9% per year during the period 1990 to 1996, they incurred trading costs of about 6.5%, leaving them with an annual return of but 11.4%, only 2/3 of the return in that strong market upsurge. Mutual fund investors, too, have inflated ideas of their own omniscience. They pick funds based on the recent performance superiority of fund managers, or even their long-term superiority, and hire advisors to help them do the same thing. But the advisors do it with even less success. See chapters 8, 9, and 10. Oblivious of the toll taken by costs, fund investors willingly pay heavy sales loads and incur excessive fund fees and expenses, and are unknowingly subjected to the substantial but hidden transaction costs incurred by funds as a result of their hyperactive portfolio turnover. Fund investors are confident that they can easily select superior fund managers. They are wrong. Contrarily, for those who invest and then drop out of the game and never pay a single unnecessary cost, the odds in favor of success are awesome. Why? Simply because they own businesses. And businesses as a group earn substantial returns on their capital and pay out dividends to their owners. Yes, many individual companies fail. Firms with flawed ideas and rigid strategies and weak managements ultimately fall victim to the creative destruction that is the hallmark of competitive capitalism, the formulation of Joseph E. Schumpeter in Capitalism, Socialism, and Democracy, 1942. But in the aggregate, businesses grow with the long-term growth of our vibrant economy. This book will tell you why you should stop contributing to the croupiers of the financial markets who rake in something like $400 billion each year from you and your fellow investors. It will also tell you how easy it is to do just that. Simply buy the entire stock market. Then, once you've bought your stocks, get out of the casino and stay out. Just hold the market portfolio forever. And that's what the index fund does. This investment philosophy is not only simple and elegant, the arithmetic on which it is based is irrefutable. But so long as investors accept the status quo of today's crazy quilt financial market system, so long as they enjoy the excitement, however costly, of buying and selling stocks, so long as they fail to realize that there is a better way, such a philosophy will seem counterintuitive. But I ask you to carefully consider the impassioned message of this little book. When you do, you too will want to join the revolution and invest in a new, more economical, more efficient, even more honest way, a more productive way, a way that will put your own interest first. It may seem far-fetched for me to hope that any single little book could ignite the spark of a revolution in investing. New ideas that fly in the face of the conventional wisdom of the day are always greeted with doubt, scorn, and even fear. Indeed, 230 years ago, the same challenge was faced by Thomas Paine, whose 1776 tract, Common Sense, helped spark the American Revolution. Here is what Tom Paine wrote. Perhaps the sentiments contained in the following pages are not yet sufficiently fashionable to procure them general favor. A long habit of not thinking a thing wrong gives it a superficial appearance of being right, and raises at first a formidable outcry in defense of custom. But the tumult soon subsides. Time makes more converts than reason. In the following pages, I offer nothing more than simple facts, plain arguments, and common sense, and have no other preliminaries to settle with the reader than that he will divest himself of prejudice and prepossession, and suffer his reason and his feelings to determine for themselves that he will put on, or rather that he will not put off, the true character of a man, and generously enlarge his views beyond the present day. As we now know, Thomas Paine's powerful and articulate arguments carried the day. The American Revolution led to our Constitution, which to this day defines the responsibility of our government, our citizens, and the fabric of our society. Inspired by his words, I titled my 1999 book Common Sense on Mutual Funds and asked investors to divest themselves of prejudice and to generously enlarge their views beyond the present day. In this new book, I reiterate that proposition. In Common Sense on Mutual Funds, I also applied to my idealistic self these words of the late journalist Michael Kelly. The driving dream of the idealist is that if he could only explain things to enough people, carefully enough, thoroughly enough, thoughtfully enough, why eventually everyone would see, and then everything would be fixed. This book is my attempt to explain the financial system to as many of you who will listen, carefully enough, thoroughly enough, and thoughtfully enough, so that you will see and it will be fixed. Or at least that your own participation in it will be fixed. Some may suggest that, as the creator both of Vanguard in 1974 and of the world's first index mutual fund in 1975, I have a vested interest in persuading you of my views. Of course I do. But not because it enriches me to do so. It doesn't earn me a penny. Rather, I want to persuade you because the very elements that formed Vanguard's foundation all those years ago, all those values and structures and strategies, will enrich you. In the early years of indexing, my voice was a lonely one. But there were a few other thoughtful and respected believers whose ideas inspired me to carry on my mission. Today, many of the wisest and most successful investors endorse the index fund concept, and among academics, the acceptance is close to universal. But don't take my word for it. Listen to these independent experts with no axe to grind except for the truth about investing. You'll hear from some of them at the end of each chapter. Listen, for example, to this endorsement by Paul A. Samuelson, Nobel laureate and professor of economics at Massachusetts Institute of Technology, to whom this book is dedicated. Bogle's reasoned precepts can enable a few million of us savers to become in 20 years the envy of our suburban neighbors, while at the same time we have slept well in these eventful times. The financial system itself, alas, won't be fixed for a long time. But the glacial nature of that change doesn't prevent you from looking after your own self-interest. You don't need to participate in its expensive foolishness. If you choose to play the winner's game of owning businesses and refrain from playing the loser's game of trying to beat the market, you can begin the task simply by using your own common sense, understanding the system, and investing in accordance with the only principles that will eliminate substantially all of its excessive costs. Then at last, whatever returns our businesses may be generous enough to deliver in the years ahead, reflected as they will be in our stock and bond markets, you will be guaranteed to earn your fair share. John C. Bogle, Valley Forge, Pennsylvania, October 20th, 2006. Don't take my word for it. Charles T. Munger, Warren Buffett's partner at Berkshire Hathaway, puts it this way. The general systems of money management today require people to pretend to do something they can't do and like something they don't. It's a funny business because on a net basis, the whole investment management business together gives no value added to all buyers combined. That's the way it has to work. Mutual funds charge 2% per year, and then brokers switch people between funds, costing another 3 to 4 percentage points. The poor guy in the general public is getting a terrible product from the professionals. I think it's disgusting. It's much better to be part of a system that delivers value to the people who buy the product. William Bernstein, investment advisor and neurologist, and author of The 4 Pillars of Investing, says, "It's bad enough that you have to take market risk. Only a fool takes on the additional risk of doing yet more damage by failing to diversify properly with his or her nest egg. Avoid the problem. Buy a well-run index fund and own the whole market." Here's how The Economist of London puts it. The truth is that, for the most part, fund managers have offered extremely poor value for money. Their records of outperformance are almost always followed by stretches of underperformance. Over long periods of time, hardly any fund managers have beaten the market averages. They encourage investors, rather than spread their risks wisely or seek the best match for their future liabilities, to put their money into the most modish assets going, often just when they become overvalued. And all the while they charge their clients big fees for the privilege of losing their money. One specific lesson is the merits of indexed investing. You will almost never find a fund manager who can repeatedly beat the market. It is better to invest in an indexed fund that promises a market return, but with significantly lower fees. Chapter 1. A Parable with a Moral. The Gottrocks Family. Even before you think about index funds, in their most basic form, mutual funds that simply buy all of the stocks in the U.S. stock market and hold them forever, you must understand how the stock market actually works. Perhaps this homely parable, my version of a story told by Warren Buffett, chairman of Berkshire Hathaway Incorporated, in the firm's 2005 annual report, will help clarify the foolishness and counterproductivity of our vast and complex financial market system. Once upon a time, a wealthy family named the Gottrocks, grown over the generations to include thousands of brothers, sisters, aunts, uncles, and cousins, owned 100% of every stock in America. Each year, they reaped the rewards of investing, all of the earnings growth that those thousands of corporations generated, and all of the dividends that they distributed. To complicate matters just a bit, the Gottrocks family, of course, also purchased the new public offerings of securities that were issued each year. Each family member grew wealthier at the same pace, and all was harmonious. Their investment had compounded over the decades, creating enormous wealth, for the Gottrocks family was playing a winner's game. But after a while, a few fast-talking helpers persuade some of the Gottrocks cousins that they can earn a larger share than the other relatives. These helpers convince the cousins to sell some of their shares in the companies to other family members and to buy some shares of others from them in return. The helpers handle the transactions and, as brokers, receive commissions for their services. The ownership is thus rearranged among the family members. To their surprise, however, the family wealth begins to grow at a slower pace. Why? Because the family share of that generous pie that American industry bakes each year, all those dividends paid, all those earnings reinvested in the business, 100% at the outset, starts to decline, simply because some of the return is now consumed by the helpers. To make matters worse, while the family had always paid taxes on their dividends, some of the members are now also paying taxes on the capital gains they realize from their stock swapping back and forth, further diminishing the family's total wealth. The smart cousins quickly realize that their plan has actually diminished the rate of growth in the family's wealth. They recognize that their foray into stock picking has been a failure, and conclude that they need professional assistance, the better to pick the right stocks for themselves. So they hire stock-picking experts, more helpers, to gain an advantage. These money managers charge a fee for their services. So when the family appraises its wealth a year later, it finds that its share of the pie has diminished even further. To make matters still worse, the new managers feel the compulsion to earn their keep by trading the family's stocks at feverish levels of activity, not only increasing the brokerage commissions paid to the first set of helpers, but running up the tax bill as well. Now the family's earlier 100% share of the dividend and earnings pie is even further diminished. Well, we failed to pick good stocks for ourselves, and when that didn't work, we also failed to pick managers who could do so, the smart cousins say. What shall we do? Undeterred by their two previous failures, they decide to hire still more helpers. They retain the best investment consultants and financial planners they can find to advise them on how to select the right managers, who will then surely pick the right stocks. The consultants, of course, tell them that they can do exactly that. Just pay us a fee for our services, the new helpers assure the cousins, and all will be well. Alas, the family's share of the pie tumbles once again. Alarmed at last, the family sits down together and takes stock of the events that have transpired since some of them began to try to outsmart the others. How is it, they ask, that our original 100% share of the pie, made up each year of all of those dividends and earnings, has dwindled to just 60%? Their wisest member, a sage old uncle, softly responds, "All that money you've paid to those helpers and all those unnecessary extra taxes you're paying come directly out of our family's total earnings and dividends. Go back to square one and do so immediately. Get rid of all your brokers. Get rid of all your money managers. Get rid of all your consultants. Then our family will again reap 100% of however large a pie that corporate America bakes for us year after year." They did exactly that, returning to their original passive but productive strategy, holding all of the stocks of corporate America and standing pat, exactly what an index fund does. And the Gottrocks family lived happily ever after. Adding a fourth law to Sir Isaac Newton's three laws of motion, the inimitable Warren Buffett puts the moral of the story this way: for investors as a whole, returns decrease as motion increases. Accurate as that cryptic statement is, I'd add that the parable reflects the profound conflict of interest between those who work in the investment business and those who invest in stocks and bonds. The way to wealth for those in the business is to persuade their clients, don't just stand there, do something. But the way to wealth for their clients in the aggregate is to follow the opposite maxim. Don't do something, just stand there. For that is the only way to avoid playing the loser's game of trying to beat the market. When any business is conducted in a way that directly defies the interests of its clients in the aggregate, it is only a matter of time until change comes. The moral of the story, then, is that successful investing is about owning businesses and reaping the huge rewards provided by the dividends and earnings growth of our nation's corporations. The higher the level of their investment activity, the greater the cost of financial intermediation and taxes, the less the net return that the business owners as a group receive. The lower the cost that investors as a group incur, the higher rewards that they reap. So to realize the winning returns generated by American business over the long term, the intelligent investor will minimize to the bare bones the costs of financial intermediation. That's what indexing is all about, and that's what this book is all about. Don't take my word for it. Listen to Jack R. Meyer, former president of Harvard Management Company, the remarkably successful wizard who tripled the Harvard Endowment Fund from $8 billion to $27 billion. Here's what he had to say in a Business Week interview. The investment business is a giant scam. Most people think they can find managers who can outperform, but most people are wrong. I will say that 85 to 90% of managers fail to match their benchmarks. Because managers have fees and incur transaction costs, you know that in the aggregate, they are deleting value. When asked if private investors can draw any lessons from what Harvard does, Mr. Meyer responded, "Yes. First, get diversified. Come up with a portfolio that covers a lot of asset classes. Second, you want to keep your fees low. That means avoiding the most hyped but expensive funds in favor of low-cost index funds. And finally, invest for the long term. Investors should simply have index funds to keep their fees low and their taxes down. No doubt about it." In terms that are a bit more academic, Princeton professor Burton G. Malkiel, author of A Random Walk Down Wall Street, expresses these views. Index funds have regularly produced rates of return exceeding those of active managers by close to 2 percentage points. There are two fundamental reasons for this excess performance: management fees and trading costs. Public index funds are typically run at a fee of less than 0.2%. Actively managed public mutual funds charge annual management and market expenses that on average are 150 basis points, 1.5 percentage points per year. Moreover, index funds trade only when necessary, whereas active funds typically have a turnover rate close to 100%, and often even more, with trading costs of at least another 0.5 to 1% of performance a year, and probably a lot more. Active management as a whole cannot achieve gross returns exceeding the market as a whole, and therefore they must, on average, underperform the indexes by the amount of these expense and transaction cost disadvantages. Experience conclusively shows that index fund buyers are likely to obtain results exceeding those of the typical fund manager, whose large advisory fees and substantial portfolio turnover tend to reduce investment yields. Many people will find the guarantee of playing the stock market game at par every round a very attractive one. The index fund is a sensible, serviceable method for obtaining the market's rate of return with absolutely no effort and minimal expense. Chapter 2. Business Reality Trumps Market Expectations. Here begins the first lesson. That wonderful opening parable brings home the central reality of investing. The most that owners in the aggregate can earn between now and Judgment Day is what their business in the aggregate earns, in the words of Warren Buffett. Illustrating the point with Berkshire Hathaway, the publicly owned investment company he has run for 40 years, Buffett says, "When the stock temporarily overperforms or underperforms the business, a limited number of shareholders, either sellers or buyers, receive outsized benefits at the expense of those they trade with. But over time, the aggregate gains made by Berkshire shareholders must of necessity match the business gains of the company." How often investors lose sight of that eternal principle. Yet the record is crystal clear. History, if only we would take the trouble to look at it, reveals the remarkable, if essential, linkage between the cumulative long-term returns earned by American business, the annual dividend yield, plus the annual rate of earnings growth, and the cumulative returns earned by the U.S. stock market itself. Need proof? Just look at the record since the 20th century began. The average annual total return on stocks was 9.6%, virtually identical to the investment return of 9.5%, 4.5% from dividend yield, and 5% from earnings growth. That tiny difference of 0.1% per year arose from what I call speculative return, depending on how one looks at it, perhaps merely statistical noise, or perhaps from a generally upward long-term trend in stock valuations, reflecting the willingness of investors to pay higher prices for each dollar of earnings at the end of the period than at the beginning. Compounding these returns over 106 years produced accumulations that are truly staggering. Each dollar initially invested in 1900 at an investment return of 9.5% grows by the close of 2005 to $14,808. Sure, few, if any of us have 106 years in us, but, like the Guthrocks family over the generations, the miracle of compounding returns is little short of amazing, perhaps the ultimate winner's game. Footnote. But let's be fair. If we compounded that initial $1, not at the nominal return of 9.5%, but at the real, after-inflation rate of 6.5%, the accumulation grows to $793. But increasing real wealth nearly 8 times over is not to be sneezed at. Yes, there are bumps along the way in the investment returns earned by our business corporations. Sometimes, as in the Great Depression of the early 1930s, these bumps are large. But we get over them. So, if you stand back and squint your eyes, the trend of business fundamentals looks almost like a straight line sloping gently upward, and those periodic bumps are barely visible. Note, however, that stock market returns sometimes get well ahead of business fundamentals, the late 1920s, the early 1970s, the late 1990s. But it has been only a matter of time until, as if drawn by a magnet, they soon return, although often only after falling well behind for a time, the mid-1940s, the late 1970s, the 2003 market lows. In our foolish focus on the short-term stock market distractions of the moment, we too often overlook this long history. We ignore the fact that when the returns on stocks depart materially from the long-term norm, it is rarely because of the economics of investing, the earnings growth and dividend yields of America's corporations. Rather, the reason that annual stock returns are so volatile is largely because of the emotions of investing. We can measure these emotions by the price-earnings ratio, which measures the number of dollars investors are willing to pay for each dollar of earnings. As investor confidence waxes and wanes, PE multiples rise and fall. Changes in interest rates also have an impact, uneven though it may be, on the PE multiple, so I'm oversimplifying a bit here. When greed holds sway, we see very high PEs. When hope prevails, moderate PEs. When fear is in the saddle, PEs are very low. Back and forth, over and over again, swings in the emotions of investors momentarily derail the long-range upward trend in the economics of investing. While the prices we pay for stocks often lose touch with the reality of corporate values, in the long run, it is reality that rules. So while investors seem to intuitively accept the idea that the past is inevitably prologue to the future, any past stock market returns that have included a high speculative stock return component are deeply flawed as a guide to what now lies ahead. To understand why past returns do not foretell the future, we need only heed the words of the great British economist John Maynard Keynes, written 70 years ago. It is dangerous to apply to the future inductive arguments based on past experience, unless one can distinguish the broad reasons why past experience was what it was. But if we can distinguish the reasons why the past was what it was, then we can establish reasonable expectations about the future. Keynes helped us make this distinction by pointing out that the state of long-term expectation for stocks is a combination of enterprise, forecasting the prospective yield of assets over their whole life, and speculation, forecasting the psychology of the market. Chapter 12 of the General Theory of Employment, Interest, and Money, John Maynard Keynes, 1936. I'm well familiar with those words, for 55 years ago I incorporated them in my senior thesis at Princeton, written, providentially for my lifetime career that followed, on the economic role of the investment company, the title I chose for the thesis. This dual nature of returns is clearly reflected when we look at stock market returns over the decades. Using Keynes' idea, I divide stock market returns into 1. Investment return, enterprise, consisting of the initial dividend yield on stocks plus their subsequent earnings growth, together the essence of what we call intrinsic value, and 2. Speculative return, the impact of changing price-earnings multiples on stock prices. Let's start with the average annual returns on stocks over the decades since 1900. The steady contribution of dividend yields to total return during each decade is always positive, only once outside the range of 3% to 7%, and averaging 4.5%. The contribution of earnings growth to investment return, with the exception of the depression-ridden 1930s, was positive in every decade, usually running between 4% and 7%, and averaging 5% per year. Result: total investment returns, which combine dividend yield and earnings growth, were negative in only a single decade, again the 1930s. These total investment returns, the gains made by business, were remarkably steady, generally running in the range of 8% to 13% per year, and averaging 9.5%. Enter speculative return. Compared with the relative consistency of dividends and earnings growth over the decades, truly wild variations in speculative return occur as price-earnings ratios, PEs, wax and wane. A 100% rise in the PE from 10 to 20 times over a decade, for example, would equate to a 7.2% annual speculative return. Curiously, without exception, every decade of significantly negative speculative return was immediately followed by a decade in which it turned positive by a correlative amount. The quiet 1910s, and then the roaring 1920s, the dispiriting 1940s, and then the booming 1950s, the discouraging 1970s, and then the soaring 1980s. Reversion to the mean, RTM, writ large. Then, amazingly, we see an unprecedented second consecutive exuberant increase in speculative return in the 1990s, a pattern never before in evidence. By the close of 1999, the PE rate had risen to an unprecedented level of 32 times, setting the stage for the return to sanity in valuations that soon followed. the tumble in stock market prices gave us our comeuppance. With earnings continuing to rise, the PE currently stands at 18 times, compared to the 15 times level prevailing at the start of the 20th century. As a result, speculative return is added just zero point 0.1 percentage points to the annual investment return earned by our businesses over the long term. When we combine these two sources of stock returns, we get the total return produced by the stock market itself. Despite the huge impact of speculative return, up and down, during most of the individual decades, there is virtually no impact over the long term. The average annual total return on stocks of 9.6% then has been created almost entirely by enterprise, with only 0.1 percentage point created by speculation. The message is clear. In the long run, stock returns depend almost entirely on the reality of the investment returns earned by our corporations. The perception of investors, reflected by the speculative returns, counts for little. It is economics that controls long-term equity returns. Emotions, so dominant in the short term, dissolve. Even after almost 55 years in this business, however, I have absolutely no idea how to forecast these swings in investor emotions. I'm not alone. I don't know anyone else who has done so successfully, or even anyone who knows anyone who has done so. In fact, 70 years of financial research shows that no one has done so. But largely because the arithmetic of investing is so simple, I believe I can forecast the long-term economics of investing with remarkably high odds of success. Why? Simply because it is investment returns, the earnings and dividends generated by American business, that are almost entirely responsible for the returns delivered in our stock market. Put another way, while illusion, the momentary prices we pay for stocks, often loses touch with reality, the intrinsic values of our corporations, in the long run, it is reality that rules. To drive this point home, think of investing as consisting of two different games. Here's how Roger Martin, Dean of the Rotman School of Management of the University of Toronto, describes them. One is the real market, where giant publicly held companies compete, where real companies spend real money to make and sell real products and services, and, if they play with skill, earn real profits. This game also requires real strategy, determination, and expertise, real innovation, and real foresight. Loosely linked to this game is another game, the expectations market. Here, prices are not set by real things like sales margins or profits. In the short term, stock prices go up only when the expectations of investors rise, not necessarily when sales, margins, or profits rise. To this crucial distinction, I would only add that the expectations market is not only a product of the expectations of active investors, but the expectations of active speculators, trying to guess what these investors will expect and how they will act as each new bit of information finds its way into the marketplace. The expectations market is about speculation. The real market is about investing. The only logical conclusion: the stock market is itself a giant distraction that causes investors to focus on transitory and volatile investment expectations rather than what is really important, the gradual accumulation of the returns earned by corporate business. My advice to investors is to ignore the short-term noise of our emotions reflected in our financial markets and focus on the productive long-term economics of our corporate businesses. Shakespeare could have been describing the inexplainable hourly and daily, sometimes even yearly or longer, fluctuations in the stock market when he wrote, "Like a tale told by an idiot, full of sound and fury, signifying nothing." The way to investment success is to get out of the expectations market of stock prices and cast your lot with the real market of business. Don't take my word for it. Simply heed the timeless distinction made by Benjamin Graham, legendary investor, author of The Intelligent Investor, and mentor to Warren Buffett. He was right on the money when he put his finger on the essential reality of investing. In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. Ben Graham continues, Using his wonderful metaphor of Mr. Market, the investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convenience, either to be taken advantage of or to be ignored. Imagine that in some private business you own a small share which cost you $1,000. One of your partners, named Mr. Market, is very obliging indeed.